what the Fed has done has put upward pressure on Main Street USA.
I think they're trying to say this is a bump in the road. Maybe bump is the new transitory.
Even if it is a bump, no one's talking yet about a re-acceleration in growth or a re-acceleration in inflation.
I do, though, think this is a fundamentally disinflationary economy, and I just worry about an overactive monetary policy which we've had for many years.
Inflation's not doing what they wanted on average, and this is a problem for them.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance. It's the calm after the bond market storm. What a difference one CPI print makes. Allow me to introduce you to a brand new bond market board. If you're away yesterday, things have changed. We've got some different numbers for you. New highs for 2024 on a 2-year, 10-year, 30-year. The 2-year getting closer to 5% at 495.66. The 10-year with a clean break of 450. The quote of the last 24 hours on this program, around this desk, JP Morgan's David Kelly. That's the sound of the door slamming shut on a June rate cut.
And this is the sound of Wall Street completely revising its estimates for when the Fed can cut across the board. Steve Englander is Standard Chartered. We revised our 2024 Fed policy rate. RBC, we are changing our Fed call from 75 basis points of cuts to only a 25 basis point move in December. Across the board, yesterday we saw the biggest sell-off, the biggest rise in Treasury yields since 2022, and it seems like there might be more behind it.
Everyone is starting to revise. Lisa, you said this morning before we started, it's the great revision of a day. Seema Shah, similar point to David Kelly. This really seals the fate for the June FOMC to push this further back. You have to think, if we came into this year expecting when will the Fed cut, now it's a matter of some people's mind if the Fed will have a cut in 2024.
It's day two. Let's talk about how this is rippling around the world, not just for the Federal Reserve, but for the ECB and the BOE. Two big headlines crossed on a Bloomberg a little bit earlier this morning. Traders pairing ECB rate cut bets to less than 75 basis points this year. For the BOE, fewer than 50. Look at foreign exchange. The euro, 107.31. The dollar having its biggest one-day move going back to the banking stress of last spring. Dollar yen, we were talking about testing 152. Never mind 152. It's a break of 153, Bramo. 153.16.
The big question behind this is how much does the hot CPI print in the United States call the hand of the likes of the ECB as well as the Bank of Japan? And how different is the inflation in the United States from elsewhere? In other words, is the U.S. still exceptional? Other places facing off with inflation, but lacking the luxury to cut rates as quickly as they might like because their currency is just weakening so quickly.
Here's the agenda this morning, Lisa. We've got to talk about the ECB at 8:15 Eastern Time. 15 minutes after that, we'll get jobless claims and PPI. Then 15 minutes after that, New York Fed President John Williams. How is he going to respond to the data yesterday and the data this morning?
And that's important because we did hear from two Fed presidents yesterday. We heard from Chicago's Austin Goolsbee, who actually had something very interesting to say, and Richmond Fed President Barkin. Both of them didn't seem ready to completely wholesale reset their expectation for a rate cut this year. Austin Goolsbee basically saying, yeah, they're definitely worse when it comes to some of the inflation reads. We're getting to the point where there's going to be more trade-offs than there were last year. Not ready to take a rate cut off the table, but maybe allowing the inflation's going to have to run hotter for them to really kind of cater to some of the pockets of weakness in other parts of the economy.
Yeah, and the other Fed official you mentioned said you have to stay humble with this kind of environment and this kind of data that's coming in. Mohamed El-Arian out with an opinion piece really reiterating and solidifying something he talked about around this table, which is that the Fed, in order to remain progress in the U.S. economy, needs to accept 2 to 3% inflation. And if they don't, they have this potential of ruining the gains that we've made in the U.S. economy.
More Fed speak a little bit later. Equity futures right now on the S&P 500. If you're just joining us, welcome to the program. Equity futures negative by 0.3% on the S&P 500. So much for the grand rotation. Underperforming yesterday, the small caps versus large. Within the equity market on the S&P 500, underperforming the equal weight versus the market cap weight S&P. And outperforming, guess what? In the face of much higher yields, the Mag 7. The Mag 7, Nvidia positive in yesterday's session. This was pretty brutal for a lot of people.
Remember when this was the rate-sensitive trade, and now it's the rate-insensitive trade, it's the safety trade? People are confused. And that's really what I feel fundamentally. How do you play an inflation story that seems like it's stickier than it was yesterday? At the same time, when you do have some companies that are feeling weakness, and clearly people are saying, I guess just buy NVIDIA.
Looking for clarity this morning. Coming up this hour, George Concarbis of MUFG following the global bond market sell-off, Stephen Cook of CFR on rising tensions between Israel and Iran, and David Cole of Julius Baer explaining why the ECB may deliver a surprise cut. We begin with our top story. Global bonds selling off as investors slash expectations for a June rate cut. George Concarbis of MUFG saying this: CPI is not PCE, and there are enough differences that this should not completely change the Fed's thinking here. That said, the inflation trajectory and current pace is an issue for the Fed as they want to cut. George is with us now for more. So, George, let's talk about it. The data yesterday, do you believe or not that puts to bed the idea of we're going to get a rate cut anytime soon?
I mean, I think it does push it off, and I think that's what we're seeing across, all the forecasters, and the market's been doing this all along ever since. And this is really the challenge. I mean, because once you get to a point where the market now is actually underpricing what the Fed has in their thoughts, it does really kind of call into question the timing and the timing is critical. The June, July, and if now that's really pushed off. The election, of course, shouldn't play a role if the data gets weaker and warrants an actual cut. But I do think that that they should cut in July. I have that part. I'm not going to change that part of the view. I think that yesterday was an overreaction by the market, but we have a big challenge now here because we were banking on, collectively, the global bond market, on synchronized easing, and now if you have this challenge, we have this unsynchronized easing, and the Fed's delayed. Other central banks are going to be worried as well. So that this does add to volatility, but where it adds to volatility is in the 10-year more so than in the 2-year.
George, lots to unpack there. The word overreaction, I want to get into that just a little bit more. Do you think an upside surprise of 6 basis points? Because ultimately that's all it was. Do you think an upside surprise of 6 basis points was worth a 20 basis point move at the front end of the curve?
That just goes to show you how lack of conviction there is in the marketplace and positioning, and how flows can change very quickly. This is a very binary market. When you're on hold and you're data dependent, both the markets and the Fed, it's going to cause these sort of reactions, in my opinion.
Although Jim Reed did put it well over from Deutsche Bank, talking about how this really calls into the question about whether the bump is really a bump. And we'd been talking about this for a long time. At what point does it become a trend and something stickier? And really, from all of the notes, it seems like people are saying this is sticky. And if you discount that, that's going to be at your peril. Why are you discounting that?
Well, because, look, the sticky versus accelerating inflation is a critical point, and it's early in the year. If we're data dependent, we have a long road ahead of us with a lot of things that can change on both, the growth side versus the inflation side. And to kind of only focus on this inflation fear, I think that could call into question. And I think the op-ed from Mohammed El-Arian is a good one. I mean, this might be a world that we're going to be trading between 2% and 3% on inflation, and to jeopardize growth because the Fed's going to wait until they see the actual improvement as well as or weakness in the economy. At that point, it's always too late.
Just to stay on the overreaction concept and just what that says about positioning, we talked a lot about the pretty dramatic moves in the Treasury market. In the currency market, as John was talking about, we saw the biggest one-day rally in the dollar going back to the height of the banking crisis in March 2023. How much are you seeing this as really the difficulty and, frankly, the challenge to some sort of synchronized rate-cutting cycle globally?
It really comes down to the FX markets. I think that's clearly the case, and we look at what's going on with dollar yen. This gets into a very potential vicious cycle where that's why the 10-year, the dollar, and oil are super critical. That macro trio is what's really going to dictate what happens going forward. And let's not forget that we've had a very accommodative, or I guess financial easing accommodative environment. If those three variables start moving in a way where it's detrimental to risk assets, then you'll get your tightening there too. So I think all this stuff is in play.
George, let's sit on foreign exchange. The euro 107, dollar yen 153, cable 125. That print yesterday, that move in yields, in rates, stateside, who does that upset more? The Bank of England, the BOJ, or the ECB?
I think the BOJ first, ECB second, BOE third. I think this is really coming down to like this 153, 155 level. It's really important on the dollar yen, and a move in the ECB. I think we've always looked at the ECB as making policy mistakes. I think they're trying to be proactive. I think they're trying to do the right thing. They probably will have to ease before the Fed, and it's going to be hard. And I think that's obviously a challenge for them. But to just kind of sit here and do nothing is not the right course of action either.
Do you think it tempers their ability to go further beyond flagging a June rate cut at this meeting this morning?
I mean, at a minimum, what could happen, I mean, because you don't want to always backpedal, and I think this could then enter into an environment where central banks ease and then they skip meetings and they try to really calibrate the message in between. I think that's really what they can do, try to really slow down the process and not change the narrative every other inflation report.
This is really difficult, George, because 152, Lisa's been talking about it, was the line in the sand for intervention, and here we are at 153. Steve Englander of Standard Chartered put a note out ahead of this. So this is before the CPI print, and this is what he said. A hot print would mean fighting market fundamentals. That's a difficult intervention proposition. Given where the fundamentals are and how strong the tide is right now against the BOJ, do you think they can intervene in the FX market anymore?
So the challenge, of course, other than just verbal intervention, is that for the better part of the last 18 months, as the Fed was hiking and then concluding their hiking cycle, and then all these eases were priced in. I mean, in many ways, Bank of Japan was hoping and banking on global central banks easing, and that would take some pressure off the currency. And then now this really does call into question that, and therefore, do you start raising rates faster, and then you get into the whole yen carry trade and the concerns around that. So I think that the Japan story is super critical. Obviously, it's important to us, and I think that it does. At a minimum, need to have some sort of intervention. I don't think that a move beyond 155 will be tolerated, and I think that we will probably see something there. But we don't know, obviously, with clarity on what's going to happen there. But I do think that it's going to now move towards, can the BOJ actually raise rates even more than just 10 basis points at a clip?
Does yesterday's print, George, really challenge this thesis that we've been hearing from a lot of guests, which is go outside of the U.S., that there's more value elsewhere, whether it's risk assets or whether it's currency, that generally it seems like the U.S. is sort of overpriced? Does that get challenged fundamentally based on the fact that the U.S. is still the one printing hot inflation as well as strong growth?
Well, I mean, if you look across your world bond screen on your Bloomberg terminal, as I'm sure you all do, the U.S. is still one of the highest yielding for developed markets. I mean, New Zealand, and a few others maybe, but there's, the attractive yields in the U.S. And that's why I feel like it's going to be hard for fixed income to go unhinged. And, this 450 level is critical psychologically, and we could go to 475 in a 10-year. I wouldn't be surprised. But nonetheless, there's, capital will come to the U.S. because of our higher yields. And I think that's going to benefit more fixed income than equities, considering where valuations are now.
Interesting. George, thank you, sir. George Concavas there of MUFG on the bond market, fixed income, foreign exchange and global central banks. The 2-year this morning, 496, the 10-year, 455. I think we have to sit on this, Bramo, just a bit longer. There is a reason, why people have been so constructive risk assets this year. One of them was this belief that the Fed put was back, that the Federal Reserve had the space if they needed to respond to adverse shocks because disinflationary trends would allow them to do so, that the emphasis was going to shift towards potential weakness and away from being worried about strength. I just wonder how much that inflation print and the last 3 prints changes that story.
It seems like the market is saying quite a bit. This morning, at least if you look at the pricing and you look at a lot of the notes, signals the beginning of a narrative shift. I don't know if it's an actual shift economically, but a pretty massive narrative shift where the bumps in the road are something that's much more intractable. And people are not just questioning when the Fed's going to cut rates, but they're actually increasing the rate that they think they're going to be able to stop at. This is a longer term kind of inflationary story that people are starting to grapple with.
Bumps in the road or new terrain. And I think after yesterday, I think a lot of people leaning towards maybe new terrain. Let's get you an update on stories elsewhere. Here is your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The Justice Department has opened an extended antitrust investigation into Nippon Steel's takeover bid for U.S. Steel. It means the $14 billion deal will likely be delayed. Both companies had hoped that they'd see approval in the second or third quarter of this year. This, of course, has become a very hot button issue ahead of the election. President Biden, for his part, said that he wants U.S. Steel to remain domestically owned, but did stop short of making an explicit push to kill the deal. Donald Trump says he would try to block the takeover. Lufthansa has secured a new wage agreement with its cabin crew after months of intense negotiations and strikes. This deal will give Lufthansa's 19,000 cabin employees a 16.5% wage increase over 36 months. They'll also get a $3,200 inflation compensation bonus as well as other concessions. The agreement will be valid and protect Lufthansa from strikes until the end of 2026. New York City and Miami's return to office rates are almost at 80%, and it's also the highest, those two, among major U.S. markets, according to one measure. The data comes from Placer AI, and it shows that Wall Street is driving the rebound in Manhattan, with big banks aggressively encouraging employees to return to office. And really, you can thank J.P. Morgan and Goldman Sachs. Those two in particular have been helping to drive the numbers up. That's your Bloomberg Brief. John.
Danny, thank you. I'm sure local politicians are lining up to thank them. Or maybe not.
All I can say, aggressively encouraged. What does that look like? I encourage you to come back to office. And if you don't, we will aggressively empty out your desk.
Yeah, that or adjust your bonus.
Yeah, exactly.
I think we've all got the message, haven't we?
I think that that's the case, and I think that there are a lot of mixed feelings about it, but this is the new norm.
This is. Equities right now negative 0.3% on the S&P. Up next on the program, growing tensions between Israel and Iran.
Our commitment to Israel's security against these threats from Iran and its proxies is ironclad. Let me say it again, ironclad. We're going to do all we can to protect Israel's security.
That conversation up next, live from New York City this morning. Good morning.
Season is coming.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead just coming out right now.
We have Take-Two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting.
Bang in line with estimates.
We will have full and instant analysis.
It all starts Friday on Bloomberg. Context changes everything.
Yesterday was an absolute sea of red. You're not getting a repeat of that, but the board's the same colour. We're negative 1/3% on the S&P 500. The dollar's stronger again against the euro, 107.27. Crude was rallying for a heartbeat. We're lower again. We're down about 0.5%. WTI, 85.73. Under surveillance this morning, growing tensions between Israel and Iran.
We also want to address the Iranian threat to launch they're threatening to launch a significant attack on Israel. As I told Prime Minister Netanyahu, our commitment to Israel's security against these threats from Iran and its proxies is ironclad. Let me say it again, ironclad. We're going to do all we can to protect Israel's security.
Here's the latest this morning. The US and its allies warning Israel of a looming attack by Iran or its proxies. The potential assault could happen in the coming days, according to people familiar with the intelligence. Stephen Cook of the Council on Foreign Relations writing this. Washington has been messaging to Iran about the consequences of escalation, but I don't think Biden or the administration's officials believe they can warn off the Iranians. The Israeli strike in Damascus was too bold, too effective. The Iranians would look extraordinarily weak if they did not respond. Stephen, I'm pleased to say, is with us now for more. Now, Stephen, we've been talking about this word imminent now for the best part of 2 weeks. Can we focus more on what the nature of retaliation, the character of it, what it would look like? What do you think it would look like?
Sure. There is a lot of speculation that the Iranians would directly attack Israel. I think that that's probably unlikely given the capabilities the Israelis have and the warnings the Israelis themselves have made that it would respond in kind directly on Iranian territory. Though I think that Israeli diplomatic installations around the world are definitely in the line of fire. In a sense, and not to torture something that people say all the time about the Middle East, but it is an eye for an eye. The Israelis attacked the IRGC commanders, Islamic Revolutionary Guard commanders, at a diplomatic installation in Damascus. It would be in keeping with the Iranians to choose their place and time to respond, but in kind against Israel's own diplomatic installations.
Stephen, if they're going to attack, say, an Israeli embassy or consulate or an official in a foreign country, what countries would be almost acceptable to Iran in order to not start a fight with that foreign country?
Well, I'm certain they won't choose the United States as their place for retaliation. But in Europe is a likely target. South America, not unprecedented. If you go back to the 1980s, Iranian agents attacked a Jewish community center and Israeli diplomatic installation in Buenos Aires. So in Asia is another place where Iran has significant capabilities and networks through its so-called axis of resistance. So those are the areas. Those wouldn't necessarily be acceptable to the host governments, but of course, taking the step of trying to attack Israelis in the United States or certain Western European countries would be perhaps a step too far for the Iranians.
Stephen, I'm hoping you can help me understand what happened in the past 12 hours when the Iranians came out and said that they were closing air traffic over Tehran, and then their news agency removed the report about closing that airspace. Was this supposed to signal that they were potentially going to have an almost immediate strike?
I do think that there's a fair amount of psychological warfare that's underway over this. This is the second time in the last 7 or 8 days in which we have been warned of an imminent attack that has not come. So indeed, I think the Iranians are trying to keep everybody on their toes and surprise them. And so I would put that in the category of a certain amount of psychological warfare underway between the two countries.
Stephen, you're speaking from Delphi, Greece, and you're at the Delphi Economic Forum, where you're going to be speaking, and you have been speaking with a lot of different leaders, not only of countries, Volodymyr Zelensky is there, but just leaders economically around the world. I'm sure they're all asking you, so how bad is this? Is this going to percolate out? What kind of chance of escalation do you see? What are you telling them when they try to game out and understand what we're working with, what we're looking at?
Yeah, I think there are two questions that people are asking. One is, will the conflict widen? And my answer to that is the conflict has already widened. If you take a look at what's happened in the Red Sea, in Syria, what's happening in Lebanon as well, then they want to know about a direct United States. I think there's a lower probability of Iran in the United States than Israel in the United States. But I think that particularly if the Iranians choose to attack against Israel directly, I think the escalation spiral is quite significant.
Do you think it's being priced in or genuinely appreciated by some of these investors and people who have kind of pushed it to the side for now?
Yeah, I think that there is, you would know better than I would about whether they priced it in, but there is grave concern about the conflict in the Middle East intensifying and becoming beyond this kind of a Red Sea theater, a Lebanese theater, an Iraq-Syria theater to a Middle Eastern theater. And that is really top of mind for people here in Delphi and I imagine elsewhere.
Stephen, can we just finish on Iran? I think Iran is very misunderstood and has been for a long, long time. They're very calculating. Everything is very precise. Stephen, can you talk to me about how misunderstood Iranian policy might be? And that question is in no way an endorsement of Iranian policy. Let me be clear about that. I just think they're increasingly misunderstood. What are your thoughts on that?
Well, no, I think that's right. And I think it's particularly misunderstood in Washington. For the better part of a decade, policymakers and analysts in Washington have believed that there could be a different kind of relationship with the Iranians, a more constructive one, when I think it's clear, recent events have made it abundantly clear that the Iranians do not necessarily seek a better relationship with the United States. They actually prefer to push the United States out of the Middle East. When it comes to this question of a response, I think you're quite right. The Iranians are more calculating, will take their time to determine where and when would be most effective to respond to Israel's strike on the Islamic Revolutionary Guard Corps' commanders in Damascus.
Stephen, thanks for making time for us this morning. Appreciate it. Stephen Cook of the Council on Foreign Relations in Delphi, Greece this morning. Crude was positive. Annmarie, it's now negative by 0.5%. Just about holding on to 90 on Brent. WTI 85.74.
Yeah, and you just have to watch what the heightened geopolitical risk potentially could mean. To Stephen Cook's point, they will take their time. The Iranians have a very almost legal way of going about this process. They encompass everyone at their National Security Council before they decide where to go, how to respond, and what the implications will that mean. I'm looking for when the U.S. Department comes out and says, do not travel to this country, when Israeli airspace closes, when airlines say, I'm not going to fly over this airspace. I think that is when you know that potentially something imminent is on the way.
I can tell you the last thing this market needs right now after yesterday is another big rally in crude. That's for sure. Just a little bit softer on the morning. Coming up next on the programme, Virginie Masseneuve of Allianz Global Investors as equities on the S&P 500 attempt and fail to recover from yesterday. Equity futures just a little bit softer. From New York, this is Bloomberg. A delayed start to therapy this morning, and by therapy, I mean the Masters at Augusta National. Adverse weather, just pushing things back a little bit. I'm going to talk to myself for the next couple of days on this.
I was going to say the same thing.
No one around this table is interested in what's about to happen.
I'll pretend.
At Augusta National
I will not
through
pretend.
the weekend. Let's turn to the market. No, equity futures on the S&P negative by 0.25%. We're down about 0.2% on the Nasdaq. Just a little bit softer here on the Russell. We're negative 0.6. We'll talk about this later, but Lisa, we've got to discuss it now just a little bit. The underperformance yesterday in the rotation trade was absolutely brutal. So large versus small. Small gets hammered. Okay, equal weight versus market cap weight. Equal weight gets hammered. This was a story repeatedly. You saw the Mag 7. What on earth is the Mag 7 doing outperforming on a day where yields are up 20 basis points? But that was yesterday.
It points to just absolute confusion. And I would say that right now, if you think about the stories, there was this idea of ongoing strength that would support some of the cyclical areas and some of the smaller companies. Those same companies that are incredibly challenged by the idea that interest rates aren't going to go down because those tend to be more leveraged to where rates are in the current moment. You put these two stories together, by NVIDIA. I mean, honestly, I can't think of any other explanation other than it's confusion, knee-jerk reaction, go to AI.
Sparked by some of this, CPI, and then into the bond market, big sell-off, big moves, double-digit moves right across the curve. The two-year yield, we were talking about 470, then quickly 480, very quickly 490, and all of a sudden, overnight, we're talking about 5%, 496, and got very, very close to that 5 handle all over again. Yields pulling back just a touch by a single basis point, the 10-year at 454.57. If you're still sticking with June, you're clinging to PPI at 8:30 Eastern time, aren't you? And jobless claims too.
This morning, the question isn't, are you cutting your rate call for this year? It's really, why aren't you cutting a rate call for this year? Why is this not indicative of something stickier? And that's the reason why I'm actually very curious to speak with the Citigroup economists later on in this morning, because they're the ones that are clinging to June. And what gives them that sense that there still is an opening for the Fed?
Mike Gapin and Bank of America as well, by the way. And Mike Gapin had this to say yesterday, and let me be clear, still sticking with June for now. Here's the quote. We think that unfavourable base effects on inflation in the second half of this year mean that the Fed could be forced to delay the start of any easing cycle to December of this year or March of next year. So the longer you wait, the harder it gets to actually start.
Which is the political question, and the reason why this is such a fraught moment. Yes, this is a Fed that wants to be politically independent. However, anything that they do right now will be perceived as political, especially if they cut rates into inflation that looks sticky, into an economy that's printing north of 300,000 jobs a month, and they're talking about a really close election. This is a very difficult moment for a Federal Reserve that wants to remain out of the fray.
That's the Fed. Let's turn the board, switch out the board and get to foreign exchange and other central banks as well. And we'll sit on the ECB, 107.32 on euro dollar. We're negative on that currency pair by another 0.1%. Under surveillance this morning, the ECB decision coming at 8:15 Eastern time, with President Lagarde speaking at 8:45. Traders now expecting less than 3 cuts, down from bets there would be 4. A cut in June is still the base case, but it's no longer fully priced. And a conversation we started the hour with was how yesterday's news would impact tomorrow's moves from the ECB, the BOJ, and others too.
It's causing headaches in Frankfurt and also as well in Tokyo, because you see this weighing on the currency pairs. When it comes to June, though, and the ECB, Jonathan, you made this point a lot of times. Shouldn't the ECB already be cutting? And Christine Lagarde said in December it is likely going to be June. So I think that's why everyone has this base case. But when you see the kind of CPI print happening in the United States, how difficult does it make that decision?
Well, let's talk about the news conference. In the news conference today, I guess one challenge, and I imagine someone in the news conference is going to ask it, how important is the FX channel to price stability? Because ultimately, this is the question we're asking. If we're going to see the Federal Reserve hesitate, hold, pause, not go anywhere, and the dollar's going to keep on ripping, the euro's going to break down. Jane Foley's joining us later. She's talking about 105. We caught up with Jeff Yu recently. He's talking about parity. They've got to explain why that might not be a problem. That's not an issue, and they can focus on monetary policy in Europe at the ECB.
You know what I'm checking right now? If the euro weakens more, airplane tickets this summer to Europe. And the reason why is because how many more people are going to go to Europe? How many people are going to go buy their goods? How much could this be positives for the nation, aside from just, importing goods at higher prices based on the currency exchange rate? To me, I mean, you have to think it's going to be a boost for people who might theoretically want to fly over there.
You're talking your book again.
No, I'm just saying, I mean, is this not where your mind goes?
My flight's already booked.
Well, this is also why Southern Europe has done so well coming out of COVID. It's the influx of Americans that want to go to Spain or Italy or Greece. I know where you're going, John.
Your flight's already booked too.
Know,
what
whatever.
are you talking about?
Okay, carry on.
And there's a G7 in Puglia if you're interested. Sort of work trip. Do you want to make that happen?
Are we going? Sure.
To try and make that happen. Are you making that happen?
I think I'm close to making that happen.
We'll try and make that happen. More US data still ahead. PPI jobless claims 8:30 Eastern Time. Investors waiting to see if PPI will confirm yesterday's hot CPI print. Commentary coming later today from the Federal Reserve. You'll hear from Williams, Barkin, Collins and Bostic all set to speak. I think number one there, Lisa. 8:45. No offence to President Lagarde. I'm going to be listening to John Williams of the New York Fed to work out what he's got to say about yesterday.
Does this change his framework? Does this start to really call into question just how sticky this inflation is? Typically, people listen to three people on the Fed. It's typically the vice chair, it's the Fed chair, and it's the New York Fed president. And the New York Fed president, when he comes out and speaks, a lot of people will view it as the proxy to Fed chair Jay Powell. If he comes out and he says, this has changed the narrative, we cannot have the justification to really cut rates at this point, that will just solidify this narrative shift that's clearly underway in markets.
Everyone's got an opinion on yesterday's CPI print, including the President of the United States. Take a listen to this.
I do stand by my prediction that before the year is out, there'll be a rate cut. This may delay it a month or so. I'm not sure of that. We don't know what the Fed is going to do for certain. But look, we have dramatically reduced inflation from 9% down to close to 3%. We're in a situation where we're better situated than we were when we took office.
Fed Chair Joe Biden with thoughts on the Federal Reserve. AMH, what do you think of that?
You think this is a headache for the Fed? This is a massive problem for the Biden administration. Not only does it mean they might not get a cut going into the election, the fact of the matter is it is April, and inflation, this kind of print means this is going to be top of mind of voters going into the summer when we're expecting even higher gasoline prices. And if you look at the items pushing up core inflation, housing, car insurance, clothing, personal care, education, household furnishings, medical care, this obviously is hitting the American consumer, and that is a massive problem for him.
I don't think he was particularly out of line with those comments, just reading them through verbatim, but it's always best. Just don't go there. Just don't talk about the Fed and Fed rates.
But this is the reason why they don't want to be cutting rates heading into this election. They don't want politicians talking about them. They don't want Joe Biden. They don't want Donald Trump. And basically, if they start cutting rates, guess who's going to talk about them? Everybody, which is the reason why it gets a little bit more fraught.
We're all talking about it. Hot inflation prints to start the year, shaping the global outlook for financial markets. Virginie Masseneuve of Allianz Global Investors watching for diverging paths between the US, Europe and China. She sees a more stable inflation picture in Europe and deflation stabilizing in China. Virginie, I'm pleased to say, is with us now for more. Virginie, before we talk about the global backdrop, can we just talk about what happened yesterday? Why the Mag 7 outperformed on a day where bond yields were up by double digits right across the curve? What do you think that was about?
Well, I think it might be positioning of people who are taking advantage of uncertainty if they don't have enough tech in their portfolio. I personally think that, the Max 7 is not particularly where you want to be. Some stocks in there are interesting, but you have to look at tech overall and really bet on quality, strong balance sheet. We still like the infrastructure, the plumbing, building, but also cyber security and the impact, if you want, of technology on the rest of the sectors in digital Darwinism, if you want. So I think on any retreat, you want to add to your portfolio if you don't have enough. But yesterday's move is perhaps a bit of an aberration.
So many people on this programme have been hungry for the rotation, been looking towards small caps, looking away from the Mag 7 to other sectors in the equity market, more cyclical themes, looking abroad as well, to Europe, to Japan and even China more recently over the last few weeks. Do you think that what happened yesterday, the resetting, repricing in bond yields, disrupts that trade at all?
I think it depends on what happens in the future. So I think we are at a crossroad of bifurcating path, if you want. Inflation in the U.S. is more sticky. We've had leading indication of this happening and growth is very resilient. You have this industrial manufacturing sort of cycle picking up. If you look at PMIs, even in Sweden, if you look at exports from Korea or Taiwan to China, I expect Chinese exports to actually be more healthy than people expect. So you have a pickup in the cycle. If that continues and inflation in the US remains sticky, that's one thing. I think Europe is well placed on the inflation front. And of course, if growth, and that's the second path, if growth actually falters and you have sticky inflation, then this is an environment that's not as positive for the market. So far, I'm still on the first path, but also we have to see what happens with oil prices and geopolitics.
Virginia, you talk about China and investing in China, which is a fascinating trade, and a lot of people are getting on board with this, actually. And it comes as right after that hot U.S. CPI print, Chinese inflation stalled out, and you can see it's moving in the opposite direction. How much is the increasing bet on China almost the diversification? It's the complete opposite story to everything else going on in the rest of the world.
Absolutely. And this is what we've been talking about for a while. The market is very cheap. It's very underowned. And the cycle is very different. We believe that the deflationary trend in China is appeasing, if you want. It's not intensifying. At the same time, we're probably about 2/3 of the way through in terms of the property issues that we have there. And consumption is stabilizing, while I believe exports will be picking up. So an environment where having a position makes a lot of sense.
Well, we see Goldman Sachs and Morgan Stanley raising their outlook for Chinese economic growth. Do you agree? Do you think actually it's going to be higher?
Yeah, I think for the first quarter, we could have positive surprise, and it will come mostly from exports. I think beyond that, as long as we have quality growth, I'm happy with it. What we're looking at in China is the power of innovation. So you have the old China, the new China, the power of innovation in tech, in health tech, in infrastructure, et cetera, is actually really fascinating. And I think a lot of people have not looked at it for a long time. There's some really interesting companies there.
Virginie, can we just finish on the United States and the prospect of much more difficult times ahead? There was a belief by some that if we had to delay rate cuts anymore, that ultimately what we were set up for was a hard landing further down the road. Do you think there are risks accumulating, chronic risks accumulating in the system? There's a phrase we hear a lot in credit, which is survive until 2025. Now, I understand a lot of supply came to market to start the year, so maybe we took some bricks out of that so-called maturity wall later this year. But do you think that could be a problem? And where would you be focused on in the economy at the moment?
Okay, so I think it's pendulum swing. Remember, end of last year, people expected 6 rate cuts. We were never in that camp. Higher for longer was always our plan, right, or prediction. I think clearly June rate cut is out of the table, and it will be later. The question is, expectations versus reality. And if you believe that we are on that first path that I talked about, where growth is actually more resilient, inflation is sticky, but it's not going back up. If you look at inventory movements, for example, we've had a lot of the destocking. That restocking or feeding that growth will continue to support growth. I think you're okay, and you will have some rate cut, but it will not be probably what people expected. If you had no rate cut, I think the market is not there to take that scenario into place, and that we could have an air pocket that will provide a buying opportunity.
Okay, Virginie, this was thoughtful. It always is. Thanks for being with us. Virginie Masseneuve there of Allianz Global Investors. Equity futures at the moment on the S&P down by something like 0.25%. Let's get to your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. McKinsey has begun a series of job cuts. The consulting giant has faced a slowdown in demand for services, even after a record revenue last year. The cuts, they hit about 360 staffers. That's about 3% of their 12,000 workforce who are classified as specialists. So this isn't the traditional consultants necessarily. A source says McKinsey's traditional staffers won't be affected. And this is, of course, after McKinsey in the past few weeks offered its UK staffers 9 months' pay to go away. Bad weather looks set to disrupt the first day of golf's U.S. Masters in Augusta, Georgia. Officials announced that the first round will not begin before 9 a.m. Eastern. World number one Scottie Scheffler is favored to win his second green jacket, but bad news for Scottie. No favorite has gone on to win the tournament since Tiger Woods in 2005. Now, as for Woods, he said that he is still capable of winning a sixth green jacket and 16th major if, quote, everything comes together. KKR, meanwhile, is weighing a sale of IPO of BMC Software that would be worth about $15 billion, including debt. Other PE firms have shown interest in acquiring the Houston-based company. No final decisions have been made, and KKR still favors an IPO of BMC, which filed confidentially last year with an SEC for a listing. Now, speaking of KKR, at 10:30 this morning, Lisa is going to have an exclusive with the co-CEOs. That's your brief, John.
Danny, thank you. Very, very cool. The KKR co-CEOs coming up a little bit later this morning, sitting down with Lisa. Lisa, what's the big focus for you later this morning?
Well, they want to grow to $1 trillion over the next 5 years. But this is what I find really interesting. They don't want to increase their headcount at all. And I want to talk about why. And is this basically a feature or is this a bug? Is this basically an AI improvement story or is it something completely else? And that's, I think, a real interesting focus.
I tell you now, it's a theme. It's a theme, that's for sure.
Absolutely.
10:30 Eastern Time. Do not miss that conversation a little bit later. Up next on this programme, the ECB rate decision on deck.
We may well see the ECB cut as often, if not more, than the Fed, which was unimaginable a few months ago. I think they're going to signal quite strongly that June is when they're going to cut, something that the Fed will not do.
That conversation up next. Live from New York City, following yesterday's blowout CPI report. 6 basis point upside surprise, just sparking the biggest sell-off worldwide. Amazing. Equity futures negative a third of 1% on the S&P. Yield just about unchanged, 453.96. Bramo's got thoughts. I know Bramo's got thoughts. Go on.
Well, I'm just going to say yes, but it was broad-based, and it was outside
Agreed.
of energy, and it was the Supercore. It was everything, and that having 4 consecutive months of 0.4% month-over-month inflation, not great.
Agreed. But it just took that much, right? Just to tip the boat to the other side.
Yeah, here we are.
Bumps no longer bumps. Maybe. The euro right now, 107.27. Under surveillance this morning, the ECB rate decision on deck.
We may well see the ECB cut as often, if not more, than the Fed, which was unimaginable a few months ago. It is having a huge impact on relative pricing between Europe and the US. And you do see that in the bond market, you see it in the currency market. I think they're going to signal quite strongly that June is when they're going to cut, something that the Fed will not do.
Here's the latest. An hour and a half away from the ECB rate decision, officials expected to hold rates steady, but markets are still pricing in a cut in June. David Cole of Julius Baer writing this: we see a good chance that the ECB will surprise with a rate cut at this meeting. The Fed is likely to cut rates as well, but with much less urgency than the ECB. David is with us on a pretty interesting call. David, let's start here. Does yesterday change anything about the way you think about this ECB?
Well, not so much about the ECB, but definitely about the Fed pressure here and more time probably before they cut rates. It might help some council members in ECB and some decision makers also to not see a big urgency of rate cuts. Why? Well, because some of the ECB mentioned that they don't want to be too much ahead of the Fed. But we think that this is a pretty much weak argument. The arguments for rate cuts are more on the fundamental side or more on the economic data side.
David, why do you think it is a weak argument? Just build on that a little bit more. Why is that so weak?
Well, because see, the argument against an early rate cut would come usually via the exchange rate. When the ECB would really be afraid of a weaker exchange rate, when the Eurozone economy needs to be afraid of a weaker exchange rate. And there we see basically an opportunity to revive Eurozone economic growth, because prices had been rising faster in the Eurozone than in the US, than in Switzerland, than in China. So in all their competitive economies, a weaker exchange rate would help to offset that a bit. And the more you surprise actually markets with a rate cut. And the more you are ahead of the Fed, the more you have these effects, which might help to rebalance a bit price competitiveness, which is pretty weak in the Eurozone.
So, David, given everything you've just said, is this a call that you think the ECB should cut rates today, or you think they will cut rates today?
Well, we think they have good reasons to cut rates, and it's definitely more in the camp of they should consider that, they should do that. I mean, all the indications we have and how the Council presents itself to financial markets is that they want to be foreseeable. And of course, when you want to be as a central bank as foreseeable and really guide financial markets, then you won't cut today. We think it's misplaced in this time. We think central banks can really live up to the traditional role of not pre-committed, of not being foreseeable for financial markets, because then they can achieve the best effects for the economy and for the inflation trajectory.
David, if I could just reframe what you're saying, and correct me if I'm wrong, are you basically saying that the euro economy needs a weaker euro right now to basically fight the fact that prices have been going up, that they're dealing with nearshoring, that they're dealing with Chinese competition, and they're trying to revive their manufacturing sector?
It would be more helpful than doing some harm. You know, when you are a central bank and you look at the exchange rate, you have two effects. One is probably reviving economic activity when really price competitive needs that. And here we see a tick. We think, yes, this is now the case in the Eurozone. And then you might be afraid that the weaker exchange rate really increases again your inflationary potential, your imported inflation. But right now, when we see in like the inflation rate, and when we look at the components, and it's most the domestic-driven sticky inflation, which is keeping inflation away from moving more strongly to 2%. It's not the imported inflation. We don't have the supply chain issues which were driving inflation 2 years ago. That's why we think, on balance, it's quite a good idea now to rely on exchange rate to revive economic growth without having really much negative effects on the inflation trajectory, on the inflation forecast for the Eurozone.
Before the show, we were asking, John asked you about yesterday's CPI print in the U.S., and you said, I believe that was the U.S. and that the ECB has a meeting today. And basically, you're completely separating the two. Is the divergence of the central bank activities a feature and not a bug, based on what you're saying with the currency backdrop?
It is definitely a feature, and it's not only central bank activity, which is different. It's really the demand backdrop. U.S. is still having strong demand of economic growth, and this shows up in quite robust economic growth. The Eurozone basically is stagnating in terms of GDP since 1.5 years. So there is a huge difference in the fundamental backdrop, which shows up also inflation and inflation expectations. And we simply think that central banks should acknowledge these different developments and act accordingly.
What do you make of the euro-dollar? Derek Halpenny pointing to 105. You have some people calling for parity. Where do you see this pair going, given the latest data we've had coming out of the United States when it comes to CPI?
Well, again, like for probably regarding fundamentals, this or the divergent fundamentals will probably not be enough to drive the euro significantly lower. You need also the acknowledgement of central banks and central bank policy. So we think that when the ECB indeed listen to the fundamental data and surprise financial markets here, then we can see that probably the euro drops out of this trading range. It had been pretty stable in the last year in a trading range. It drops out of the trading range and goes really below the 105 and really in direction of parity.
Certainly wasn't stable yesterday, that's for sure. David, thank you, sir. David Cole there, Julius Baer, with some thoughtful stuff on the ECB, reasons why they should be cutting interest rates today. We'll get that rate cut call at 8:15 Eastern Time. Consensus view. The consensus view is no rate cut today at all. This from Kit Jukes of SocGen this morning. As the saying goes, if it looks like a duck, swims like a duck and quacks, it's probably a duck, or in this case, a problem for dollar bears, bond bulls and the FOMC. The question we're asking, is it a problem for the ECB and the BOJ?
Or is it actually a feature for the ECB? And this is kind of what we heard from Jeff Yu earlier, and this is kind of what we just heard there from David, this idea that they want a weaker euro to stimulate their manufacturing industry, as well as, I mean, it's been stimulating the tourism industry for quite a while. This, to me, is one of the key questions. How far can that go? And is this divergence going to be okay for a little bit, but not too long?
107.29. Jane Foley coming later looking for 1 05. Coming up next to the second hour of Bloomberg Surveillance, we'll catch up with Katie Kaminsky of Alpha Simplex, Henrietta Trace of Vader, Maryland Governor Wes Moore, and Ian Lingen of BMO. Katie Kaminsky coming up in about 5 minutes' time. And Bramo, short treasuries before, and I imagine more reasons to be short based on what we've seen.
Yeah, she tried to go long for a hot second, and then she said, this is really difficult, no way, and got ahead of this move. Key question here is, what's the next step? We heard a lot of people overnight talking about 5% 10-year yields, the sky's the limit. Is this people just getting over dramatic because, it seems like something that everyone is doing, or is this something that has legs?
Don't you like how most people in fixed income appear just to be momentum traders? They come on and they say, yeah, it's going to be a buy when it backs up to 450. Where are all the headlines? Where are all the notes of people screaming buy, buy, buy with a 10-year back at 450?
The problem is, this is such a hard market to call. I know I sound like a broken record, but what conviction can you have when people can't agree on what the terminal rate is?
450. 450.
Are you trying to sell something?
No, I'm just saying that this is what everyone wanted.
Where were you yesterday at 1 p.m.?
Right now, the 2-year.
Where were you? They could have used you.
Where were you at yesterday's auction?
I thought you were doing it.
The 2-year.
450.
496.
451.
I do the auction.
452.
That's why I can't take you Mitch's calls. Oh. Because I'm busy in the afternoon
is that
doing
really
the bond auctions for Treasury.
Well, I should call you.
That's what I do.
Well, yeah,
everyone
who knew?
knows that.
I thought you would care more about it then. Come on.
Inflation will be sticky, but that shouldn't stop the Fed because the 2% inflation target is too tight.
They've created a financial market environment that's much too accommodative for what their desire to cut rates are.
I think that this lack of stability is going to be with us for a while, and I don't think that they have a clear strategy for how to manage it.
Frankly, even if they cut this year, is not going to be as relevant as whether we are indeed in a soft landing.
The sound that you heard there was the door slamming on the June rate cut. That's gone.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The door slams shut on a June rate cut, and Wall Street is playing catch-up big time. Some big shifts in the last 24 hours. Talk about market to market. Goldman Sachs, Jan Hatzius shift their call from June to July after shifting it from March to June. Steve Englander over at Standard Chartered go down from 4 to 2. Everyone's had to make some big changes, including everyone in fixed income. Check out this board now. The 2-year, the 10-year, the 30-year, with some brand new numbers for 2024. 495.45 on a US 2-year, on a 10-year. Lisa, a clean break of 450.
You talk about the changing narrative and the revisions across Wall Street, and the yield space right now speaks to revisions not only on the front end, on this idea of when the Fed can cut, but how far the Fed can cut rates. You mentioned Stephen Englander. Not only did he revise his Fed forecast in the near term, but he said we now expect the trough of the Fed funds target to be 350 rather than 325. This is an entrenched feeling that inflation is going to run hotter for longer, and that's what the market is really trying to come to terms with.
That's the direction of travel, has been now for the last 4 months. It just picked up big time in yesterday's session. It was a big question of when, not if, and now apparently it's if, not when.
And I think we have to wait for that PPI report to finally be the final nail in the coffin for some of these individuals betting when the Fed is going to cut rates. I look to Morgan Stanley's Ellen Zentner. She's basically saying the June rate cut is in jeopardy. It's on life support. And she says, dependent on the PPI data, this print tilts the Fed toward a later start in the cutting cycle. So let's see what PPI comes in. But pretty much everyone is expecting we're all in towards the end of the year.
8:30 Eastern time for PPI, together with jobless claims. The estimate for jobless claims, 215. The previous week, 221. Tons of Fed speak as well, including New York Fed President John Williams. Now, New York Fed President John Williams, you remember back in December where he poured cold water over the December rate cut conversation, which was sort of engineered by his boss, Chairman Powell, in the news conference that month. I wonder what he's got to say later on today.
If you think about it, taking a step back, some people say this is all the Fed's fault. Because, of course, they say that because they're always going to blame the Fed no matter what happens. But people saying that the change in communication materially loosened financial conditions at a time where inflation had not died. And that actually financial conditions are easy, not because of rate policy, but because of jawbone policy. And so how do they jawbone policy a different kind of message, right? How do they sort of give communication that counters the narrative in the market without totally undermining any credibility that they have left?
Those words reminded me of what we've heard repeatedly from Torsten Slock over at Apollo, who has said that the easy financial conditions have been a factor. We can talk about how big a factor, but a factor in what we're seeing. This was a quote from him yesterday. 3-month annualized change in Supercore inflation, now over 8% and accelerating. 6-month annualized change is 6% and the year-over-year change is 5%. We're sticking to our view that the Fed will not cut rates in 2024? Is he finding more and more company as we get more and more data?
Without a doubt. I mean, the market basically confirms that. We're seeing now just 2 rate cuts being priced in, and tepidly at that, not even. There is this question of what we could be missing. And of course, Steel Data on Q yesterday came out and said, just quit it, guys. We are seeing disinflation. Check out wages. If you look at the Atlanta Fed wage tracker, you do see that. People point to quits, people to point to small business optimism falling off a cliff. There are reasons to see this. The problem is, how much can the Fed really justify making a shift, given the hot inflation reads, the strong labor market prints, and the political backdrop that really creates a fraught situation?
I'm glad you brought up the political backdrop, because Paul Donovan at UBS is talking about actually they are seeing deflation in every consumer price prospect. But in certain states, he points to clothing prices in Tampa. He points to plunging communication prices in Chicago. It's difficult to argue, he says, that structural inflation stickiness exists when every key sector has deflation, but somewhere in the country. This is what makes it so complicated.
The PPI, jobless claims coming up a little bit later. Equity futures right now on the S&P 500, negative 0.25% on the S&P, just a little bit softer after yesterday's big sell-off. Bond yields just about unchanged, 4.5457 on a US 10-year. In the FX market, the dollar stronger against everything yesterday, just a rip-roaring rally. Against the euro this morning, stronger again, 107.30 ahead of the ECB. Coming up this hour, Katie Kaminsky of Alpha Simplex on the risk of even higher inflation still ahead. Maryland Governor Wes Moore on rebuild efforts in Baltimore. And Ian Lingen of BMO following the biggest rise in 10-year yields since 2022. We begin with our top story, a bump in the road or new terrain. Investors closing the door on a June Fed cut following another hot CPI print. Katie Kaminsky of Alpha Simplex warning of even higher inflation ahead, writing this. The real concern is future CPI prints given current commodity trends. Should the inflation data start to pick up further, we could see potentially even higher rates in the short term. Katie's with us now for more. Katie, I want to understand what things looked like for you yesterday. Do you and the team just sit there smiling, watching yields rip and the dollar rally?
Well, the truth is short signals have been very consistent this year. They haven't really sort of come to fruition because they've been anchored on a dovish Fed. But what is happening now is the breakout that we've been looking for in fixed income, which is basically identifying that there is more inflation than people would like, and that inflation is going to be harder to get lower. The biggest thing I've been watching before yesterday was commodity prices. Take a look at precious metals, industrial metals, and energy. They have already started to move substantially before this event, which is going to be a tailwind for a better inflation number in the future, which means we're here for longer.
You were short bonds into it, and I think that's the question, why you should stick with that trade for longer. Can you build on the signal coming out of the commodity market? And I want to introduce crude as well, $90. What gives you the impression that these kind of levels in commodities are sustainable and they'll carry on driving these moves in fixed income?
Well, if you look at where some of the commodity prices have moved, it's been substantial. Take a look at copper. Take a look at gold prices, and we can talk about that in a minute because it's a little different, but also energy. And when you see how much those prices have increased in the last 6 weeks, we've also seen some of the disinflationary pressures that we saw in agricultural sectors dissipating and bottoming out somewhat in February. This means that a lot of these disinflation trends, and in fact now uptrends, are starting to be visible in some of these raw commodities, which tend to be sort of the leading indicator to issues that we see. This is exactly what we saw in 2022 when we saw such a high inflation print later in the year. So there is some concern that this is going to be a tailwind for the narrative of the future CPI later this year as these prices put pressure through the system.
We've been talking a lot this morning, Katie, about where the bond market moves have really been coming. It's been interesting on the short end, makes a lot of sense, pretty directly correlates to Fed policy. The long end is really the confusing part for us because we are seeing people reset longer-term inflation expectations. Where are you most short? Are you seeing some of these shifts in momentum in the long end with the idea of people really questioning whether this Fed has the conviction and the will to bring inflation lower in light of some of the commodity and industrialization moves?
Well, signals across the bond curve technically are still short across the curve. A little shorter, stronger on the short end, but there's still really a lot of concern for long-term bonds. And the concept of this is very straightforward. If inflation remains sticky, then there's a chance that really sort of owning long-term bonds could potentially really have a deterioration in value? Should we stay sticky in inflation? Or should we cut and then not need to, and thus those bond prices in relative terms with inflation sticky become vulnerable? So I think a lot of people are not thinking about long-term cash flows are actually quite vulnerable to a sticky inflation and longer-term inflation expectations, which means that there's still definitely downward pressure in those markets.
At the same time, you have people who say, look to recent history. Every time yields got to a certain point, it brings the buyers in. We've heard buyer after buyer, potential buyer after buyer, talk about how it looks really attractive to lock in yields at this level. What are you seeing on the technical level about whether people are lining up to buy at certain levels or whether that bid has evaporated along with the narrative?
Well, this is not a conversation I'm seeing right now because I think people need to have more clarity on how long it's going to take to cut. So if they really did believe that cuts are coming sooner rather than later, then you would definitely expect that people want to get in and lock in those higher rates today. But given all of the commentary about inflation, stickiness, and sort of the long-term battle that we have ahead of us, it's still really unclear at what point we're going to get that buy signal. I know we got it in October when we saw a 5% 10-year, but we're still really far from that 5% at this point. So maybe 5% is that point where people start to say, there's no way we're going higher. But it could still be a case, like I said, that we had a big steepener where people are concerned about even higher inflation. That's a rare event, but it could happen.
Katie, you name-checked gold as a little bit different than the rest of the broader commodity space. On this program, we've heard people talk about sanctions policies, geopolitics, inflation hedge. What do you give this gold resilience to? What does it come down to?
For us, I think it's really about real rates. And that's actually something that's been very interesting to me for the last month. Gold prices have gone way up. And so if you take this very simple analogy, if you were say, for example, going to buy your S&P with gold, actually, in some sense, the S&P hasn't gone up in real terms. So that's something that we have to think about in an inflationary environment, that if we have some inflation is good for equity nominal prices. But the fact that gold prices have increased so much suggests that real rates are not as attractive. So people want to actually have gold as a store of value. So in gold terms, equity markets are actually gone down in value. So if you kept your gold at home, you could actually buy more S&P.
Katie, gold's really confused me, and you've confused me there too. So I'm going to have to go back to those comments and listen to them twice, maybe 3 times. Katie, can you explain really clearly what on earth is going on with gold and its relationship to bond yields? Because for most of this year, over the last couple of months specifically, gold's rallied, yields have climbed. Odd relationship, but it's been developing. Then yesterday happened. Yields ripped, gold dropped on a hot inflation report. Katie, what's that about?
That's a trickier one because that's a one-day move. I'd say that the more recent move to us has looked like decreasing real yield. So if you have inflation increasing, you want to hold gold as a store of value. On the other hand, when you have the situation like yesterday, it may be the case that people see it as a opportunity to take profit in gold. I'm not sure, because yesterday was definitely a very idiosyncratic day. But in general, gold has been increasing as a safe haven asset where people are thinking about inflation potentially ticking up as something where you want to store value. And that's why it's interesting that the S&P relative to gold hasn't really increased.
Yesterday wasn't a one-day move. It was a one-year move in the bond market, Katie. Katie Mincy there of Alpha Simplex. Katie, thank you. Short fixed income, short bonds, and let's face it, after yesterday, right to be. Lisa, looking at gold this morning, positive by 0.2%.
You pointed to yesterday's sell-off in gold. Just want to point out Bitcoin was up, just theoretically. I mean, one day to move isn't going to do anything, but I do wonder if the sort of new trade that's developing is short bonds, long gold. Basically, if you believe inflation is going to tick up and suddenly we're going to talk about the deficit and all that, the auction yesterday, go forward, go crazy. But this question of whether gold is sort of the new ballast and the new haven on the margins, given central bank buying and other concerns, bonds not so much.
It's hard to keep up, that's for sure. 8:30 Eastern time, more to talk about. We're going to get data, PPI, jobless claims as well. 8:15, so 15 minutes before that, you get an ECB rate decision. 15 minutes after that data, so 8:45 Eastern time, you'll hear from President Lagarde. And at the same time, you should hear from John Williams of the New York Fed as well, with some comments, hopefully, on yesterday's data. Equity futures negative here by 1/3% on the S&P. Let's get to your Bloomberg brief with Danny Berger. Hey, Danny.
Hey, John. Allianz's chief economist Ludovic Sabran says the ECB is now in what he calls a pickle, now that the Fed cuts are likely to be pushed out, widening rate differentials between the two.
The sensitivity is the following: 100 basis points difference on the interest rate differential is 4 to 5% depreciation on the euro dollar. Markets could be spooked that the ECB threw the baby with the bathwater a bit early.
Sabran spoke to me earlier on the Bloomberg Brief, which you can catch every weekday at 5 a.m. A who's who of business and tech leaders gathered at the White House last night for a state dinner in honor of visiting Japanese Prime Minister Kishida. Jamie Dimon, Larry Fink, Tim Cook, Jeff Bezos were all among the high-profile attendees. There are also some celebs. Robert De Niro and Olympian Christy Yamaguchi were also in attendance. U.S. credit card delinquency rates were the highest on record in the fourth quarter. That's according to a report from the Federal Reserve Bank of Philadelphia. Almost 3.5% of credit card balances were at least 30 days past due as of the end of December. That's up by 30 basis points from the prior quarter. The number of debts that were 60 and 90 days late also climbed. That's your Bloomberg Brief. John.
Hey, Danny, thank you. Up next on the program, antitrust action heating up over U.S. steel.
I stand by my commitment to American workers. I give a man of my word, I'm going to keep it. And with regard to that, I stand by our commitment to our alliance.
We'll follow that story next on the program, live from New York City this morning. Good morning.
Season is coming.
I think we're all asking the same question.
Just how much earnings growth they're expecting.
Bloomberg is first to break the numbers.
Gilead just coming out right now.
We have take two numbers.
Shares of Pinterest.
Lucid Group coming out with its earnings.
All eyes right now on NVIDIA.
A lot still to come.
With the smartest insights.
How much bigger could profit and revenue have been?
Better than what the street was expecting.
Bang in line with estimates.
We will have full and instant analysis.
It all starts Friday on Bloomberg. Context changes everything.
Equity futures on the S&P 500 negative here by a third of 1%. Yields up again. Nothing like yesterday, let's be clear. Up a single basis point today. Double-digit moves yesterday right through the curve. 455.59 on a US 10-year. Under surveillance this morning, antitrust action heating up over US steel.
I stand by my commitment to American workers. I give a man of my word, I'm going to keep it. And with regard to that, I stand by our commitment to our alliance. This is exactly what we're doing, a strong alliance as well.
Here's the latest. President Biden pledging his support for American workers as the DOJ opens an extended antitrust probe into Nippon Steel's bid for U.S. steel. At a meeting with Biden at the White House, the Japanese Prime Minister weighing in on the deal, saying, quote, Japan believes that the U.S. government will proceed appropriately and in accordance with the law. Henrietta Trey's of Vader Partners joins us now for more. Henrietta, can you just walk us through how thin this tightrope is for the President of the United States on these issues?
That's a fair way to say it. I would maybe encourage people to think of how long that rope is. I would imagine it goes all the way through the November elections. Ever since this deal was announced, there was immediately to my mind an understanding that this is going to take a very long time. There's no reason that this has to be approved before the election. I do think that, to acknowledge your point about how tricky a tightrope this is, they really just need this to be thoroughly vetted, dot all the I's and cross all the T's, but very likely it will take well into the fourth quarter of this year. And I suspect after the election, there's no reason to inflame risk or risk any tensions from either side. I think Nippon Steel can be patient, and I think the DOJ is going to do a very thorough accounting of the entire situation. So I expect this to take a while.
In some ways, they're lucky that this is Japan, because Japan has been very respectful, very aware. They know exactly what is going on. This is about November. So let's talk about November. Is it working? When you make moves like this, or suggest you will make moves like this, to attract the vote in places like Pennsylvania, there are signs that this is beginning to work.
The way I think about the election at this stage, when we're really in the heart of it, is you're trying to see an absence of unforced errors. So former President Trump came out aggressively against the deal, and President Biden is not going to give him an inch of any kind of wiggle room to either tack further to the right or hard line on trade with him. This administration has been very conscientious of where the Trump administration in 2017 took us on trade. All the existing tariffs on China, for example, are still on. The Section 232 steel and aluminum tariffs have been suspended, but they're still in existence. So there's this weird nexus of the world where Democrats and Republicans under President Trump, former President Trump, have sort of overlapped a lot on trade. And I think they're both making very similar points, and it's one that Democrats feel very comfortable making, and former President Trump is trying to sort of outflank throughout this process.
Your base case is that Biden will win another term for the White House. Yesterday, we had hotter than expected CPI, a lot of concerns about what this means as voters head to the poll. It's still one of the top concerns when we go out, when Gallup goes out and takes these surveys. How do you see the president potentially shifting in how he talks about the economy? Because it's not working.
Yeah, it hasn't worked all year, despite the fact that the economy has improved and CPI has come down substantially since the midterm elections. I think what I would encourage folks to do, and I just published a report on this, is look historically at what voters say they care about. It's consistently the economy. In this point, the economy and inflation in your polling is 31% of the population's number one issue if you combine the two of them. The issues are tremendously important, of course, especially at the household level and amongst female voters in the United States. They have a 10% more negative view of the state of the economy than male voters do. Perhaps because they're more exposed to making household purchases. And obviously gas prices continue to be an issue going into the summer months. But look at what happened in 2022, for example, and 2023. Even when inflation was at 9% in the run up to the election, who won the election? Democrats across the board. And that was in the Senate, where they picked up a seat despite having majorities in the House, Senate, and the White House. President Biden's approval rating was through the floor. It was completely underwater. And voters still gave the Republican Party the worst showing of a minority party since the 1930s. So the question you have to ask yourself is, when voters say the economy and inflation are their number one issues, just like they did in 2022, how do you justify then them going into the ballot box and pulling the lever for Democrats, which they've done consistently from Ohio to Kentucky, just as recently as 5 months ago. And so while immigration and now crime and sort of terrorism are top issues amongst Republican voters, what we see time and again, and specifically just 5 months ago in the sort of first in the nation votes on the 2024 election in Ohio and Kentucky, as well as Virginia, is that abortion is the, in fact, driving motivator in getting people to the polls. And when they go to vote on anything, when they get in the ballot box, they pull the lever for Democrats. And I suspect it's largely for abortion. So the rulings on IVF in Alabama, the 6-week ban from the Supreme Court in Florida, the new ban from the 1800s in Arizona, which was just upheld last night by the Republicans in the House and Senate there, are the real problem. And I think a real factor in the election, more so than the economy, because people, it's sort of nebulous to say, I'm voting on the economy. You really go in and say, what do I have to actually change? What does my vote impact? And it's abortion.
So it's almost like a protest poll. I'm fed up with these gasoline prices and I'm fed up with what's going on in the grocery. But then you go into the polling booth and you're like, actually, what matters to me most is abortion. In that sense, then, what's going on in Arizona, does that shore up the Democrats can control that Senate seat? Because when it comes to the Senate, the Republicans really have an advantage.
When it comes to the Senate, Republicans are in a position of extreme strength, both geographically and statistically. All 8 seats that are even worth monitoring right now are Democratic seats that Republicans are putting up real fights for in mostly purple and even red states. I mean, Democrats have no business winning 4 election cycles in the Senate in Georgia in the last couple of years, let alone Arizona and keeping Nevada. I mean, those states should be Republican, but they're not. And I would say that there's one reason for that, and it's ever since 2016, it's Donald Trump and it's abortion, and they lose every time.
And you can see how it's becoming a bigger problem for them. Henrietta, just President Trump and how Carrie Lake even have responded to that decision. How are they responding? How are they messaging to the electorate?
Arizona is such a perfect encapsulation because we have Ruben DeLeo, who's even more progressive than Joe Biden. We have Carrie Lake, who's a perfect proxy for Donald Trump in the MAGA universe. And then we have Kyrsten Sinema, who I think is a great proxy and stand-in for Nikki Haley. And you're seeing the trends in that state consistently outperform Biden and Trump at the top of the ticket, with Ruben DeLeo outperforming in fundraising to a much greater extent. Carrie Lake is trying to distance herself from her historical statements on abortion. She used to be a strong proponent of exactly the law that was passed, or excuse me, the Supreme Court decision. And now they're sort of trying to backtrack. But to get back to the original point about unforced errors, if a former president is going to come out and say, I support states' rights, and then the state goes and acts the next day, this is exactly what he said he supported. So it's really hard to distance yourself from it. And I think you're going to see that in the polls in the next couple of weeks.
Seeing a lot of it. That's so well framed. Henrietta, thank you. Henrietta Trace there of Vader Partners. Arizona's fascinating right now, seeing how this is playing out.
And also, they had a potential incumbent when it comes to Kyrsten Sinema. She decided to become an independent and she's not running. It's very fascinating. And what's happening in abortion, I mean, this law was on the books before Arizona actually became a state. And what's happening there has the Republicans scrambling. And potentially this could give the Democrats not just a seat, but bite in the presidency.
We support state rights, but just not state decisions like those. Seems to be the theme.
They put themselves in this box. And that is the problem. And how do they get out of it? How do they communicate? Because we know that Donald Trump and Republicans, they struggle with women and suburban women. And you see a ruling like this, and this is very unnerving. And even if they're annoyed with grocery prices, to Henrietta's point, they'll go vote on abortion.
Big focal point going into November. Equity futures right now on the S&P 500. If you are just joining us, welcome. A little bit softer here. We're down about 1/3 on the S&P. Coming up next on the programme, Baltimore hoping to have its port fully restored by the end of May. Maryland Governor Wes Moore joins us next. From New York City, this is Bloomberg. And pause. Yesterday was like a week, a year's worth of price action in the bond market. Look at things now. Softer again on the S&P. We're negative 1/3 on the Nasdaq. We're down about 1/4. We're down 0.7% on the small caps. The small caps yesterday getting absolutely hammered. In the bond market, if you were away from the market yesterday, this is a big reset for you. Totally different numbers. The 2-year with a move of about 20 basis points, 496.30. Yields a little bit lower this morning by a single basis point. The 10-year with a big adjustment as well. We're talking about double-digit moves right the way through the curve. 2-year, 10-year, 30-year. And we're talking about new highs for 2024 as well. 455 on the 10-year. Lisa has talked a lot about auctions. Yesterday was a really sloppy one. And a little bit later, Lisa, the 30-year bond, $22 billion worth this afternoon.
At a time when people can't really put a finger on what inflation is going to be over the longer term, because yesterday wasn't just a reset about Fed policy. It was a reset about how sticky this inflation is and what that means longer term, which is why you had dealers taking up the greatest amount of yesterday's 10-year auction going back to late 2022. Do you see a repeat of that as people really push back and say, wait a second, we have to rethink exactly what levels we're looking at longer term?
Possibly a reset in foreign exchange as well. So let's switch at the board and get to FX and start with the euro. The euro breaking down to about 107, 107.31 later on this morning. So about 45 minutes from now, we'll get an ECB rate decision. That's a weaker euro, a much stronger dollar in the last 24 hours. And even for dollar yen, for the Japanese, for the Bank of Japan, we were talking about 152 as the line in the sand. Forget 152. We cleaned out 153 in the last 24 hours.
And this isn't something that Bank of Japan or any Japanese officials can really easily fight against, because it really is just a fundamental shift. This is the dollar ripping at the greatest pace yesterday since the banking crisis back in March of 2023. So at what point do central banks welcome this? And at what point do they just sort of accept it? And how much do they try to fight it?
The dollar stronger against G10 in a big way. Under surveillance this morning, a fresh read on the US economy coming in just under an hour with PPI and jobless claims at 8:30 Eastern time. That'll be followed by a slew of Fed speak. We'll hear from Williams, Barkin, Collins, Bostic, all on deck, and you'll get a lot more going into the weekend as well. It's Williams for me, Annmarie. I think that's got to be the focus of the big three on the FOMC. The New York Fed president, his thoughts on what happened yesterday morning.
And what does that mean in terms of the path for the Fed, and how many rate cuts is the market right when they're starting to say, actually, it's going to be 2 or maybe even less? We heard from Barkin yesterday. I loved what he said. He said, quote, "We're making a lot of progress. We need to be humble about how easy it is to get there." So the Fed wants to be a little bit more humble. And Steve Risciuto yesterday, for me, hot landing. That's what he calls this is. And whether or not the Fed, and potentially we'll hear that today from the New York Fed president, whether or not they're going to have to accept a 2 to 3% inflation landing in order to cut rates and continue the economy moving.
That's definitely been a theme through the pandemic and coming out the other side of the pandemic, humility. I think we all need a dose of humility. Very, very unsure as to what is happening in the economy and what is happening in markets too. So we spent the last couple of weeks talking about a big rotation in markets to small caps, away from mega cap tech. What happens yesterday? Small caps get hammered. Mega cap tech, the Mag 7, they do okay. More on mega cap tech. Amazon, the CEO Andy Jassy has just published his annual letter to shareholders, expecting the company's cloud infrastructure to become an essential part of the generative AI boom, saying, quote, "Much of the world-changing AI will be built on top of, guess what? AWS. So I guess the shareholder letter this morning, Lisa, is a pitch to investors to buy, because this is where it's going to be for AI.
It's a pitch to investors saying, stop telling us that we're losing the race with Azure of Microsoft. We're not. This is absolutely in our repertoire, and we're doing just great. Whether people buy it is another question, but it shows where the race is. It is in terms of consolidating cloud ownership, in terms of the AI space, and dominating it in a way that Google's having a lot of trouble doing.
But this also follows his letter last year. He talked about how they want Amazon to help fuel the artificial intelligence, boost efforts to develop and build Amazon franchises, groceries, health, et cetera, et cetera. It's basically the same thing, but revamped and a lot more fuel to that fire.
Amazon just a little bit softer in the pre-market. Let's turn to our next story. The NTSB said its investigation into last month's Baltimore bridge collapse is honing in on the vessel's electrical system. President Biden saying the federal government will pay for the bridge recovery and rebuild. Meanwhile, the governor of Maryland saying he hopes to restore full service at the Port of Baltimore by the end of May. I'm pleased to say that with us is Governor Wes Moore. Governor, thanks for giving us your time this morning. I know it's been a very difficult month for you and the people of your state. Very, very difficult. I want to start with this because the President of the United States, President Joe Biden, has committed to funding the cost of the rebuild. How confident are you that he can get that financing through Congress?
Well, I'm confident that it's imperative that we can get it done. If you look at the economic impact of the Port of Baltimore, the Port of Baltimore is worthy and contributes about $70 billion to the American economy. The Port of Baltimore is the largest port in this country for new cars, for heavy trucks, for agricultural equipment, for spices and sugars, for coal. That a huge chunk of the American economy relies on the Port of Baltimore. And so I'm thankful that the president has led and rightfully acknowledged that what happened last week was not just a human catastrophe. I mean, we lost 6 Marylanders during this catastrophe. And it was not just an economic catastrophe for Maryland or for the region. This was an economic catastrophe for the country. And so our ability to be able to rally in a bipartisan fashion and to be able to get the port reopened and reopen the and get the bridge rebuilt is going to be a national priority.
So 2 issues there. So reopen the port and reopen the bridge. Can we deal with the first one first? Reopen the port. How straightforward is that going to be?
This is a remarkably complex operation. We've never had a maritime disaster like this where you have not only a ship, a vessel, that's the size of the Eiffel Tower and the weight of the Washington Monument that is now stuck in the middle of the Patapsco River. And part of the reason that it's stuck in the middle of the river is because it has a bridge, an iconic bridge that's sitting on top of it. 3,000 to 4,000 tons of steel are sitting on top of the bridge, and the remainder of the bridge is sitting at the bottom of the river. So this is still a remarkably complex operation, one where we have our divers who are in there every day, and they literally cannot see anywhere between a foot or 2 in front of them because of the amount of wreckage that's in the water. And so the ability that we've now been able to open up 2 channels that can now have up to a 14-foot depth. So you can get certain commercial vehicles. We've had 59 commercial transfers that have already taken place. And hopefully by the end of May, we'll have fully functioning operations for the port. Is a staggering accomplishment when you think about the speed and the coordination that was required in order to make that happen.
So end of May for the port, Governor, but what about the rebuild of the bridge? What does this timeline look like?
The rebuild of the bridge is going to be a longer timeline. The thing that we know is for that bridge, that over 36,000 people went over that bridge every single day. That was the bridge that got people from where they lived to where they worked, from where they lived to where they worshipped, to where they lived to where they went to school. It was also a key and a crucial part of port operations because for the Port of Baltimore, it's not just maritime operations, it's also rail and it's also truck operations that exist in the Port of Baltimore. And so in order to truly get the Port of Baltimore up and going in the same kind of fashion that it was before, getting that bridge rebuilt is going to be imperative. And we know that's going to be a longer timeline, but we are committed to making sure that we get the key bridge rebuilt.
And I know that's why you're going to be in Washington today to be speaking to lawmakers about the funding to rebuild this. I was struck by what Senator Cruz said yesterday. He says that he wants to get this rebuilt as soon as possible, but he said it's bureaucratic dithering and lengthy environmental reviews, kind of blaming it on Democrats for this bureaucracy, environmental reviews that could potentially make this a long-term process and not as quick as, say, you and residents of Maryland want to see. Do you agree with him that this should be really fast-tracked?
Well, I'm thankful that Senator Cruz is a yes on making sure that we can get 100% funding for it. And I'm thankful that Senator Cruz understands how imperative it is that we both get the port reopened and also get the bridge rebuilt. I also know that the White House, I mean, I had my first phone call from the White House at 3 o'clock in the morning of the tragedy. And the White House has been with us every single step of the way. The Secretary of Transportation was literally down there, boots on ground before noon, to be able to assess the damage and assess what they can do to help. I have yet to receive a phone call from Senator Cruz. I've yet to receive a visit from Senator Cruz. I would welcome him to come to Baltimore for him to see exactly the circumstances and the situation that we're dealing with. And I'm sure when he came, he would also see that there are members of the Biden administration who have been on the ground the entire time, and I'm sure he would spend time with them as well when he came to Baltimore. I know this needs to move quickly. This needs to move fast. We need to focus on safety, and we've got to get this thing rebuilt. And I'm glad we are building a bipartisan support structure around what it's going to take and around what that can look like.
You talk about how quickly it's important to rebuild the bridge, and I know a lot of people would agree from every facet of the region. How much are you exploring other types of financing if it doesn't come from the government, whether it's issuing municipal bonds or getting public-private partnerships?
I think that all options should be on the table, and all options are on the table. You know, I don't come from a political background. I'm an Army guy. I was a paratrooper with the 82nd Airborne Division, and then when I left the Army, I started a business. So I understand the role that the public sector, the private sector, that philanthropy is also going to play in this. And even if you just look at the past week, you know, we've used every lever at our disposal to be able to address this issue. I actually issued an executive order that released $60 million of state funding that went towards supporting our port workers. We actually signed legislation that focused on things like providing scholarships to the children of transportation workers who have died on the job, and also providing additional supports for businesses. We also helped launch something called the Maryland Tough Baltimore Strong Alliance, which is over 80 organizations, private sector, businesses, and philanthropy. We've now raised over $15 million that's going towards port workers, and also have a commitment from businesses to do things like they're not laying off their workers. If they have to temporarily move operations from the Port of Baltimore, they've committed to bringing them back to the Port of Baltimore. So we know it's important to use every single lever at our disposal, and that every sector, private sector, public sector, philanthropy, have all got to be involved and at the table in order for us to get to our long-term conclusions.
Well, as a Marylander, as a business owner, as a military man, you fully understand the importance of infrastructure and what the ramifications could be the longer that this goes on. Is there a drop-dead time where, say, it takes 2 years and that's the maximum that it could take to rebuild this bridge and get operations, to reopen the port, to get things back up and running, where Maryland, Baltimore can withstand that, versus after that, where it becomes a real financial weight that has much more punitive consequences?
Well, it's a financial weight now. And it's the reason that we are moving as fast as humanly possible. It's the reason that we have 24/7 operations that are going right now. And that cadence, that speed, it's not going to stop. I'm committed to making sure that we are moving with speed on this, because we have to remember there are tens of thousands of port workers that right now are being impacted by this. There are entire communities that now have watched their way of life completely upended. There are industries that the country relies on that are now at either a stop or a stall because of what has happened with this port tragedy. And so, you know, the how imperative it is that we move fast on this, it sits with me every single day. And I know we are going to, and I'm going to demand 24/7 operations until we accomplish 4 goals. Bring closure to these families, reopen these channels, make sure we're taking care of our people who've been impacted by this, and getting the bridge rebuilt.
Governor, how much money do you need?
Well, the truth is that we don't have an official price tag on that right now. That we know this is going to be a long journey. We know this is going to be something that is expensive. We also know, though, taken place thus far. If you would have asked me 2 weeks ago, seeing what I saw, and said that 2 weeks later we would have 2 commercial channels open. That by the end of this month, we should have up to a 35-foot depth in draft that should be able to get a lot of the new cars and roll on, roll off that the Port of Baltimore relies on up and going. And by the end of May, we should have the port fully functioning. I would have said, when you look at the damage and the devastation that we saw, I would have said that seems very ambitious. But that's where we are. And so we know this is going to be a long journey. We know this is not going to be an inexpensive journey, but it's a journey that we all have got to be committed to, because this means everything to not just our region and our state, but to the long-term growth of maritime operations in the American economy.
Governor, we appreciate your time, and I know this is going to be a long road ahead for you and your state, and it's going to be an ongoing conversation, and hopefully we can talk to you again in the future. Governor Westmore, thank you, sir. The governor there of Maryland, difficult conversation, difficult time for his people in that state after the Baltimore Bridge collapse. Bramo, it's important to ask, how much money do you need? I'm not expecting a precise figure. I need $2.whatever billion. But if you go into Congress, they're going to want to know what's the price tag.
And to understand exactly how it's going to be deployed. I mean, when you started talking about how challenging it is to move something that's equal to the Monument or the Statue of Liberty or the Eiffel Tower, and you've got steel over it. Here's the issue, though. At what point does some of the dock work move away from the region? At what point does the traffic push people away from living in that region? There are all of these longer-term implications that go on the longer it takes to really rebuild.
We have at least a timeline on when the port will be fully open, the end of May, but no timeline on how to rebuild this bridge. And Jonathan, to your point, how much it's going to cost? One professor at the University of Chicago was looking at what happened when the Mario Cuomo Bridge, the Tappan Zee Bridge, similar comparisons, rebuilding that. He said it's going to be at least $4 billion. And potentially that number can get higher.
Yeah, a line of credit, a big, big number, and maybe an indefinite commitment as well. Let's give an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hi, John. The U.S. and its allies are warning Israel of a missile or drone strike by Iran or its proxies. People familiar with intelligence say that the attack against military and government targets in Israel may happen in the coming days, a significant widening of the conflict. The Justice Department has opened an extended antitrust investigation into Nippon Steel's takeover bid for U.S. Steel. The companies had hoped for approval in the second or third quarter, but this will likely delay it. The takeover has become a hot-button issue for this presidential election. President Biden says that he wants U.S. Steel to remain domestically owned, but stop short of making an explicit push to kill the deal. Donald Trump, for his part, said he would try to block the takeover. Bad weather looks set to disrupt the first day of golf's U.S. Masters in Augusta, Georgia. Officials announced that the first round won't begin before 9 a.m. Eastern. World number one, Scottie Scheffler, is the favorite to win his second green jacket. But bad news for Scottie. No favorite has ever gone on to win the tournament since Tiger Woods did in 2005. Now, as for Woods, he says that he's still capable of winning a sixth green jacket and 16th major if, quote, everything comes together. That's your brief, John.
Danny, thank you. Nothing else matters this weekend. Nothing. Scottie Scheffler, Rory McIlroy, Xander Schauffele teeing off a little bit later. I've got no idea when because of the weather.
Can I ask you, when does it end?
Sunday.
Okay.
Why?
We have a few days left.
Honestly, it's fine. I get to watch him. I get to watch him
relaxing.
just talk to himself or talk to the screen. You know, viewer, please write in.
Everyone at home knows this is the most therapeutic golf tournament on the planet. Yeah, it's just quiet. It's beautiful.
Look at that.
It's perfect. There you go. Up next, see, you've got it. You can join Jim Nantz this weekend over at CBS.
Okay.
Slamming the door on June.
The sound that you heard there was the door slamming on a June rate cut. Jay Powell wants to achieve consensus. He can't convince the committee of something that the committee doesn't, on average, want to believe.
That conversation up next, live from New York. This is Bloomberg. Session lows on the S&P 500, negative by 0.5%. Bit softer this morning, a lot softer yesterday. Yields up a single basis point, adding some more weight to that 10-year yield, 4.56 after a double-digit move yesterday. Under surveillance this morning, slamming the door on June.
The sound that you heard there was the door slamming on a June rate cut. That's gone. Jay Powell wants to achieve consensus. He can't convince the committee of something that the committee doesn't, on average, want to believe. I still think that they ought to normalize rates over time. I'd be happy enough if they start to cut rates in June, but I think this means that they won't.
It's the latest this morning. Bond yields soaring on the heels of another hot CPI print, with investors now expecting the Fed's first rate cut to come in September. Ian Lincoln of BMO writing this: if the Fed needs more convincing, Powell run-ups against the optics of cutting rates immediately after the presidential election. We're not willing to take a September first cut completely off the table, but it would require a very sharp deterioration in the labour market to justify seriously pondering a September departure point. Ian, I'm pleased to say, is with us around the table here in New York. Ian, good morning to you.
Good morning. Thanks for having me on.
Let's start at 8:30 yesterday. Let's pretend it's just dropped. If we were a few basis points lower on CPI yesterday and we rounded down to 0.3 instead of rounding up to 0.4, how different would our conversation be this morning?
I think that if we'd actually seen a 0.3 print instead of a 0.4, we would be looking at the data. We might be parsing through some of the details, but we would be thinking that the Fed had it right to assume that January was just a bump on the road to normalization, and we would still be talking about a June rate cut. And so the fact that we're here, no one is expecting June, everyone thinks that September is going to be hard to pull off, I think really is a fascinating moment for the market.
When the Fed looks at it, how many decimal points is it looking to?
Well, this is where I think it gets very interesting, because the Fed is looking at the translation of CPI and PPI to core PCE. And we actually don't have a solid estimate of what PCE is going to be yet. We'll get that after PPI today.
I do wonder about how much people are looking at the potential for a Federal Reserve to make a policy error based on the political calendar. Because essentially, they have the same conviction that they had earlier about the economic backdrop, but it is highly inconvenient to cut rates at a time where inflation is coming in hotter than expected, 0.4% month over month for several months in a row, and you have a north of 300,000 jobs number.
I'd argue that the negative impact from the election on monetary policy already occurred, and that was in the form of the December pivot. Powell wanted to get ahead of the presidential cycle, socialize the idea of cutting rates, and that's why we rallied into the end of the year, and the Fed has been walking that back throughout much of this year.
Meanwhile, we're talking about how that pivot really fueled these easy financial conditions. How much do you think that that's been fueling a lot of the inflation that we saw yesterday versus just been, sort of a side story to the whole thing?
At the end of the day, I think that it's the resilience of the labor market that's really driving the Supercore measure of inflation. We had 3 relatively strong average hourly earning prints during the first quarter. And yes, the lofty valuations in the equity market matter. The comparative stability in the housing market matters as well, because it contributes to the wealth effect. But at the end of the day, if we have a 3.8% unemployment rate, it's difficult not to see some degree of inflation on a arguably sustainable basis.
Given that potentially we're going to see more sustainable inflation on this basis, you're talking about, when you look at the jobs market, I still can't get over that more people are working more than one job to keep up with paying their bills. Is that kind of deterioration worrisome for the Fed?
I would certainly think that it is, because we tend to see that dynamic develop at the end of a cycle. It's similar to the way we often see a divergence between the household and the establishment surveys when things are about to turn. And I've personally been very surprised that we haven't seen a more significant correction toward a higher unemployment rate and a weaker jobs profile overall.
Favorite question of mine for you: is this bond market a screaming buy now? Big reset yesterday.
It's getting to the point of being a screaming buy, but we actually did a client survey last week.
I saw that, yeah.
This was ahead of the payrolls number, and the average response said that people would be interested in adding treasuries at roughly 465. If we did that survey now, I expect that number would be a bit higher.
475. This is what drives me nuts about the bond market. People say there's a point where they want to buy, and then the treasury market starts selling off and they run away. Are we all just momentum traders and fixed income?
I think that people have a spread from where we currently stand, where they would get really excited, and that
it's a rolling 15 basis points.
It always seems to roll a bit higher until something happens.
Well, if the Fed doesn't cut rates in June, which is what people are expecting, does that make you more bearish or more bullish on the long end?
It ultimately makes me more bullish on the long end, because the reality is, as long as the Fed's holding that 2% inflation target, they might find themselves in a situation where they have to cause a recession or they have to cause a more material slowdown to get inflation back to 2%. So it's a bit counterintuitive because everyone is now in the no landing or the hot landing camp. But this really complicates things for the Fed.
Are you buying?
Not yet.
Let's finish on language, if we can. I just want to squeeze this in. The chairman has said repeatedly it's too early to know whether these are more than just bumps. Are they more than just bumps now for the Fed chair?
I think that this is a meaningful change in the broader inflation narrative. It is more than a bump, but it doesn't mean that the Fed has lost control of inflation.
Okay. Ian, this was great. It's good to see you, as always. Ian Lincoln there of BMO. On this bond market and this rolling, I need an extra 15 basis points, an extra 20 basis points in fixed income. The 10-year, you got an extra 20 yesterday, and now you want another 20. 456 on a 10-year, up 2 basis points this morning. On a 2-year, very close to 5% at about 4.98. Coming up in the next hour, the third hour of Bloomberg Surveillance, we'll catch up with Jason Thomas of Carlisle, Jane Foley of Rabobank, looking for the euro to drop back to something like 105. We'll speak to Robert Sokin of Citi as well, with the ECB rate decision about 20 minutes away, and then 15 minutes after that, Lisa, on deck, PPI and jobless claims.
Which really will be the final read in terms of understanding the components for core PCE, which is what the Fed looks at. What I think we just heard there from Ian Lincoln, though, this was a clear pivot point. This was a shift in terms of what the Fed can do and how the market's perceiving that. And that is really what I want to hear from the New York Fed president.
That's why the highlight might be John Williams.
Yeah.
At 8:45 Eastern Time, if we get some comments on that inflation data from yesterday. Equity futures on the S&P 500. If you are just joining us, welcome to the program. We're lower again. Session lows. We're negative 0.5%. From New York, this is Bloomberg.
What the Fed has done has put upward pressure on Main Street USA.
I think they're trying to say this is a bump in the road. Maybe bump is the new transitory.
Even if it is a bump, no one's talking yet about a re-acceleration in growth or a re-acceleration in inflation.
I do, though, think this is a fundamentally disinflationary economy, and I just worry about an overactive monetary policy which we've had for many years.
Inflation's not doing what they wanted on average, and this is a problem for them.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Okay, we're a few weeks into Q2. I just want to go back to the start of Q1. First trading day of the year. We're sitting there. We're going to get 6 to 7 rate cuts in 2024. Buy bonds. You want yields here. You might not get them in the future. Okay, here we are 3 months later. Bond yields are higher by more than 70 basis points at the front end of the yield curve. Yesterday, we got an extra 20. Double-digit move right the way through the curve. And here we are pricing in not 7, not 6, not 5, 4 or 3, but maybe 2 or nothing from the Federal Reserve later this year.
People had flirted with transitory earlier this year, and they got their faces ripped off again. And that's essentially what we're looking at, with the Fed basically talking about immaculate, or they never talked about this, the market talking about immaculate disinflation, and now we're looking at just inflation.
No, the Fed's been talking about bumps in the road repeatedly, and now they've had 3 of them so far in 2024. And I've got to give it to Priya Misra. I think with quote of the year so far, maybe bumps in the road are the new transitory. And based on yesterday, Anne-Marie, maybe she's got a point.
Yeah, these look more like baby hills than bumps. I was struck by what Ian Lincoln said, because everyone's talking about how uncomfortable the politics might be of this, because you see the market really pushing back the first cut potentially to September. What he had to say, though, is that what the Fed did in December in their pivot and that rally we've seen in the equity market, that was the election hype that Powell set the table for, not this potential cut that might come a month or two before the election, and with monetary policy having a lag effect, won't really do much.
Let's sit on that theme, that word, uncomfortable. Let's talk about uncomfortable the next 45 minutes. 8:30, so 30 minutes from now, we'll get jobless claims and PPI. And then at 8:15, so 15 minutes before that, you'll get an ECB rate decision. At 8:45, you'll hear from President Christine Lagarde of the European Central Bank. And we'll talk about what uncomfortable looks like in foreign exchange. It's the euro around 107 with cause for parity again. It's dollar yen taking out 153. And maybe a BOJ that can't intervene because they're going against the fundamentals of the US economy and the fundamentals of Federal Reserve policy, and a much, much stronger dollar. How uncomfortable will some of these central banks be?
I thought you were going to take that somewhere else. You know what's uncomfortable the next 45 minutes as I sit here with you guys talking about this? No, I'm looking at this sort of question about the FX channel here.
Is that how you feel?
No, not at all. That's why I was so
uncomfortable
surprised.
as if he misses tea time of the Masters.
But if it's uncomfortable.
Tea times are delayed for the weather.
Oh, thank God.
All right, good news.
It's okay.
Carry on.
It'll be great. Look, I'm looking at the FX channel and I'm thinking to myself, how much is this actually a benefit for some of these central banks? And I go back to the ECB and the idea of a weaker euro actually being positive on the margins, not too much. And so they can diverge, but just not for very long. And I wonder how much Christine Lagarde's going to really point to that.
Japan's top currency diplomat, almost immediately when these yen moves came in, quote, recent yen moves are rapid. Quote, won't rule out any steps to respond to disorderly FX moves. Quote, prepared to take necessary action. Quote, won't comment whether overnight Forex moves are excessive. Quote, excessive FX moves could affect the economy. Continuous, almost this, not even uncomfortableness, like almost obsessiveness on, oh my God, where's that new line in the sand going to be with the yen? I'm not sure if we'll get that kind of uncomfortableness from Christine Lagarde.
So I won't offer my opinion. I'll just go on the programme in the last 90 minutes or so, the last 2 hours. MUFG, George Conclave's basically saying this is more uncomfortable for, say, the BOJ than it is the ECB. And what we heard from Julius Baer was essentially that maybe this is what they want, Lisa, to your point. They want a weaker euro because the growth backdrop in Europe compared to the United States is a very, very different story.
And it's really the manufacturing sector that they need to revive. The fact that Germany is the sick dog of Europe right now, and it's also was the strongest dog. So how do you then bring up some of that growth at a time where there's a lot of China competition, especially with inflation? And that really does lead to the currency channel.
That decision from the ECB, 10 minutes away. Equity futures right now on the S&P, negative by 0.5%. We can turn to foreign exchange briefly. The euro, a little softer, 107.29. Yields up again after big moves yesterday, up by 2 basis points. The 10-year, 456.81. Coming up, we'll catch up with Carlisle's Jason Thomas on why the Fed is more likely to hike than cut. Rabobank's Jane Foley reacting to the ECB decision. And Citi's Robert Salkin on why global central bank caution will continue. We begin with our top story. Stocks mixed as sticky inflation dims rate cut hopes. Carlisle's Jason Thomas saying this. It's more likely that rates would move up than down. Fed policy on the whole is too accommodative with their guidance toward rate cuts. There isn't a case for cuts. Jason joins us now for more. Jason, wonderful to get your thoughts on this programme. Thanks for being with us, sir. How did yesterday change your base case for 2024?
Well, I think the discourse needs to change. Since the November 1st FOMC meeting, we've observed a massive easing of financial conditions. Stocks up by about 25% on average, with fairly broad participation in that rally. 10-year yields fell peak to trough by over 100 basis points. And also credit markets. If you look at single B spreads and high yield bonds, just over 300 basis points, within 50 to 60 basis points of the all-time tights of that time series dating back since 1996. So this response in financial conditions since November is actually looks reminiscent of what we saw when the Fed launched rounds of QE in the past decade. And I think that, it's not the base rate, which has remained unchanged, that's so central to inflation determination, but of course these broader financial conditions. So I think today the Fed has to look at these data, look at a services sector that looks to be bursting at the seams, just as the demand in experiences, entertainment services continues to grow, and really just change this discourse to think right now that, looking forward, we don't see any rate cuts. And then I think you can allow for a tightening of financial conditions that may eventually, by year end, put you in a situation where you're feeling more comfortable on the inflation front.
Jason, what I hear from you is that you think we need tighter financial conditions. The Fed chair says we are sufficiently restrictive. Do you think we are insufficiently restrictive based on what I'm just hearing?
Well, of course. I think, again, as of November, the Fed said that they didn't need to hike further because financial conditions had tightened sufficiently. The market effectively did the Fed's work for it. And I think that was right at the time. But again, when you look at whatever metric one wants to look at or collection of metrics to try to ascertain where financial conditions stand, it's hard to say that through the first 3 months of this year, you had tight policy. It's not the base rate that matters. The Fed funds rate is an overnight interest rate that is applied to about $85 billion of transactions. It's meaningless. It's only the extent to which those instruments, the balance sheet, the base rate, guidance, actually influence financial conditions. And again, on that score, you would have to conclude that policy has been too easy to hit a 2% inflation target. And I think that gets into questions about, is the Fed, effectively, implicitly moving to a higher target? If the discourse doesn't change, I think that is going to be the takeaway among many market participants.
Which certainly is what we're seeing and hearing in all the notes overnight as people look at maybe a 2 to 3% range for the potential for inflation. As an investor, though, when you take a look at how easy financial conditions have been, do you push against that? Do you sell credit? Do you avoid those areas? Or do you lean in and say, this is a Fed that wants to remain accommodative and that wants to run this economy hot?
Well, I think running the economy hot, may turn out just fine. The economy is performing very well. Earnings growth looks very solid. I think the risk in the situation, however, is the federal budget deficit. And what I mean by that is some market participants may conclude that the Fed is not moving to a higher inflation target willingly. It's actually succumbing to fiscal dominance. And it's now setting policy based on the funding needs of the Treasury, setting policy so as to limit the Treasury's net interest expense, which, of course, has been growing explosively. And if that happens, if that is a broadly shared sentiment, watch out for long-term bond yields. Because if a central bank is setting policy, again, on the basis of what the Treasury, the fiscal authority, needs to fund itself, it loses control of the price level. Again, these are tail risks. This is not anyone's central forecast. But as these perceptions gain hold, you could be looking at much, much higher long-term bond yields and a much steeper curve. So for me, in this environment, I really like floating rate loans, CLOs, where you're actually profiting from riding out these base rates. As mentioned earlier, that this idea of needing to buy bonds because they go to 4.5% or 6% in some investment grades, let's lock in these yields now. That's proven to be a bad trade, and I think there's a lot of embedded duration risk that people need to be cognizant of.
Jason, you have a lot of proprietary research overseeing all the portfolio companies at Carlyle. What's your understanding of what benchmark rate becomes restrictive for these companies? At what point these higher yields really do pose an existential risk to their business models?
Well, I don't see existential risk, but what I would say is that over the past several months, and certainly much of 2023, the expectations of rate cuts and the expectation that the terminal rate is still much, much lower than current levels of the Fed funds rate allowed a lot of businesses to swap 2-year, 3-year to 5-year and lower their borrowing costs. So again, it's not the overnight rate that matters. If you had a flat curve at 5.3%, or if you had an upward sloping curve from 5.3%, that would be more than sufficient, I think, in my view, to bring inflation down to target. So again, it's not the base rate that matters here. Secondly, I would just say that one of the effects of higher interest rates that's been interesting is, of course, increasing finance costs. So it's more difficult for consumers, of course, to buy homes, but also durable goods, renovations. So what's happened is the spending has actually moved to experiences, to services. And again, this is precisely where the inflation is. If you look at household balance sheets, what you find is about 85% of the debt is fixed rate. Almost 3/4 of that is of course, long-term mortgages. The effective interest rate being paid on that $13 trillion stock of mortgages is still only 3.8%. So you have the rate hikes have done nothing to dent household cash flow. So households on average are still able to spend with the growth in compensation. Again, because of higher finance costs, it's meant that spending has been redirected into experiences.
Jason, this was deeply thoughtful stuff. Appreciate your time. And hopefully we can do this again soon. Carlisle's Jason Thomas there on this market and the Federal Reserve not being sufficiently restrictive, but insufficiently restrictive. Equities right now on the S&P, negative 0.5%. Up next on the program, the ECB rate decision. The decision from the European Central Bank just seconds away. The scores going into it shaping up as follows. I'll begin with equities and we'll work our way through the bond board and finish on the euro. Equity futures on the S&P 500 negative by 0.5%. We're down another 1/3% on the Nasdaq 100. In the bond market, the scores following yesterday's major moves. Stateside, Treasury yield higher by another 2 basis points, 4.5620. And in foreign exchange for the euro, hit hard by the data from yesterday and the bounce in yields. The euro negative to 107.33. Interest rates just about unchanged then, 4.50 on the refinancing rate against an estimate of 4.50. The marginal lending facility at 4.75 as expected. The deposit facility, that interest rate coming in at 4% against a median estimate of 4% and a previous number of 4% as well. Great expectations that maybe the ECB is going to make a move sometime soon. They've signalled quite firmly that that could come in June. The question we've had over the last 24 hours is whether the CPI data stateside would change that story with them, given the strength of the US dollar and the weakness we've seen in the single currency. So rates unchanged at the ECB and a bunch of headlines, Bramo, to work through.
Yeah, we're looking at the idea that they do plan to focus on the idea of reducing inflation in a timely manner, which is interesting given that there seemed to be more flexibility in the time that we heard from Fed Chair Powell, also talking about how they do see substantial progress when it comes to the disinflation in the region, and they are going to continue applying flexibility on the PEP reinvestment. So to me, the idea of sufficiently restrictive being a key term that they keep using, and the fact that they want to have a timely reduction in inflation kind of pushes against this idea of being a lot more dovish in the face of what some people are talking about might be an opening for them.
The things the ECB can say, I think, today that the Federal Reserve can't. This quote right here from the ECB in their statement: financing conditions remain restrictive and the past interest rate increases continue to weigh on demand, which is helping to push down inflation. But domestic price pressures are strong and are keeping services price inflation high. I want to cross over to Lizzie Burden and catch up with Lizzie over in Frankfurt. Lizzie, a lot of attention on this ECB news conference coming up later on this morning in about 30 minutes' time, given there is still expectations out there that they're going to cut interest rates in June when maybe the Federal Reserve cannot. What do you see in communication this morning?
Yeah, John, just looking at this decision, it is exactly what we expected in the sense that they stood pat here. Why? Well, they've told us why. They've said inflation's continued to fall. Most of the measures of underlying inflation are easing. The rate level's making substantial contributions to reaching that 2% level. But you've already seen services inflation sticky, yes, but growth prospects in the euro area improving. So it gives them room to wait a little longer. They have said that they want to wait for that wage data in June before making the decision. So as you say, really in this press conference, we're listening to Christine Lagarde on her tone as to the path for rates beyond June, because economists were expecting quarter-point cuts each quarter off the back of this. You've seen traders changing their pricing, holding ECB rate bets steady, in fact, pricing 19 basis points of cuts by June. So that's the reaction in markets.
Lizzie, this line here from the European Central Bank, not pre-committing to a particular rate path. Lizzie, how different is the communication we're getting from the ECB, or how similar is it to the coverage that you do for us over at the Bank of England? How similar are those two stories at the moment?
Nobody wants to be the unreliable boyfriend, John. Look, from the ECB, there's nothing explicit here, and that's kind of what we expected, that they're not going to want to make commitments before seeing that crucial wage data. And it's the same picture in the UK from the Bank of England, because there's so much uncertainty in the economic outlook at the moment. But the big question for the ECB is, when the divergence from the Fed, as you say, looks inevitable, what about euro weakness? I know you spoke to Mohamed El-Erian warning about euro-dollar parity. Will Christine Lagarde in this press conference mention that volatility in the exchange rate and the potential for it to feed back into Eurozone inflation? That's what I want to listen for.
Lizzie, it's interesting you mentioned foreign exchange, because we are seeing the euro soften a bit versus the dollar after this release, which was sort of surprising to me, given that at least the risk of them having a cut at this particular meeting has been taken off the table. Is there anything that can be viewed as particularly hawkish in this release?
Well, we didn't expect to see a cut today. In fact, only one of 62 economists that Bloomberg surveyed expected to see a cut today. So that in itself isn't dovish. Just looking at it, given that traders aren't changing their pricing off the back of it, it doesn't seem especially hawkish yet. But this is why Christine Lagarde is going to have to mind her tone especially carefully in this press conference today, with an eye on euro weakness.
Lizzie, great to see you over in Frankfurt, Germany. Lizzie Burden there of Bloomberg breaking down that ECB rate decision. A key quote, key paragraph, I think, in this statement this morning that a lot of people will be going over. If the Governing Council's updated assessment of the inflation outlook, the dynamics of underlying inflation and the strength of monetary policy transmission were to further increase its confidence that inflation is converging to the target in a sustained manner, it would be appropriate to reduce the current level of monetary policy restriction. That quote, if you're sick of hearing that, you're going to be very, very ill at the end of the news conference, because I think you're going to hear that on repeat from President Lagarde. You'll hear from President Lagarde in about 25 minutes' time. Jane Foley of Rabobank joins us now for more. Jane, those three conditions at the ECB, do you think we're pretty close to meeting them to cut rates in June?
I think we are pretty close to meeting them, but certainly had you asked me yesterday morning before the CPI data in the US, I would probably said, yes, we're even more close to reaching them. There has been a little bit of a thorn in the side. What impact will the exchange rate have on the timing, not just necessarily of the June move, or if there is a June move, but actually further out during the end of this year. But, there is one caveat, which I really do think we need to throw in this context. I think the weaker euro is probably only of significant relevance to ECB policy decisions if we are simultaneously getting a hike in the oil price. Now, we've seen Brent today trading at the $90 a barrel level. Clearly, last week, this week, the market concerned about an escalation in the crisis in the Middle East. If oil trades higher, then the weakness of the currency becomes a bigger issue. Other than that, if oil prices were lower, I'd be feeling a lot more comfortable about the ECB cutting interest rates despite a softer euro. And that is because the very fact that the central banks are turning towards interest rate cuts means that they're in the transition. They're pivoting away from inflation concerns towards growth concerns. And that means that the softer euro is going to be less of a problem. But that oil price could certainly be an issue for them.
Jen, you nailed it. I want to stick on that theme. I think it's important. Let's go through those three conditions again. The Governing Council's updated assessment of the inflation outlook, the dynamics of underlying inflation and the strength of monetary policy transmission. Just on the third one, the strength of monetary policy transmission, does it weaken if the euro is too weak and crude start running away? Does that mean one of those conditions just can't be met?
Well, quite possibly. If the euro is weak and oil prices are strong, then you're going to get more imported inflation. And therefore, you have less confidence if you're at the ECB that inflation can be brought down to target sustainably. And I think, there's been a lot of emphasis on the word sustainably from various different central banks in the last couple of years. So that is a significant risk to them. That said, if we look at the Eurozone economy, particularly maybe the German economy, and reference it back to the US, well, we see a lot of weakness. We see, stagnation that's been going on for some time. And I would say that there are an awful lot of German companies who are still reeling really from the energy price crisis in Europe, that they would actually really benefit from a softer euro because it would help their exports. But that can only happen if the ECB is confident that inflation can remain at these lower levels.
Jane, can you put some price levels on it in terms of what price of crude it has to look like for the ECB to get confidence to cut rates, and frankly, with the idea of a weaker euro?
I think with all of these levels, it's the price plus the volatility that we're seeing. And I think that really does depend on the news. It's quite likely, again, ahead of the coming weekend, that the market will probably take oil price a little bit higher just in case we get an escalation in the news from Iran. Maybe it'll come back down again on Monday like it did in the week just gone. So it's very difficult to predict what's going to happen. But I would certainly say that if we saw oil prices pushing up to 100, and if that happened quickly, then we're perhaps looking at a different sort of scenario. Now, that may not mean that there's a change in June expectations, but it may mean that there's a change in expectations about how many interest rate cuts we could potentially get from the ECB or for other G10 central banks, for that matter, during the course of the rest of the year. So I think oil prices really do have to be brought into the equation over the next few weeks, next few months maybe.
Jane, so you're looking around 105 for the euro dollar. I'm just wondering how much more there is to the dollar strength that we've seen, given that does continue to be the haven trade in light of the recent inflation data.
Well, you can talk about it as a haven trade, but I think there's that is certainly part of it. But there is just the inflationary impact. I mean, if we look ahead, and we've been talking about this for a while, if we look ahead to the U.S. election, if we were to get maybe a Trump presidency, he's talked about some very significant tariffs. Now, that means prices of some U.S. goods could go up quite substantially. That would mean that actually the Fed's easing cycle could be really quite short. Maybe 2 interest rate cuts this year, maybe 2 next year, and then that's the end, or at least a pause into the middle of the year, because CPI could get another push up because of that. So, there's a lot of variables here, but generally speaking, most of them are speaking to a stronger for longer US dollar.
Hey, Jane, wonderful to get your reaction to that ECB decision. Jane Foley there of Rabobank, unchanged to the ECB, still expecting a change from this European Central Bank, perhaps in the month of June. You'll hear from the President, Christine Lagarde, in 20 minutes' time. The next stop for this market, some data for you. PPI data and jobless claims just around the corner. Citi's Robert Socket is going to be with us to react to all of that. Will this really slam the door shut on June? Because I know for those of you still clinging to a June rate cut, PPI data is kind of the last piece in the puzzle. That data is up next. Equity futures session lows, negative 0.5% on the S&P 500. Yields are higher again. We're up 3 basis points on a 10-year, 4.57. From New York, the data up next. Next up for this market, PPI data, jobless claims, second to wait. Going into it, the scores look like this. Session lows on the S&P 500, down 0.5%. Some pain in the small caps yesterday. Again this morning, the Russell down by 1 full percentage point. In the bond market, switch up the board. 2-year, real reset, very close to 5%, 498.63. Yields up a single basis point. On a 10-year, up 2 basis points, 456.81. With your economic data, here's Mike McKee. Morning, Mike.
Good morning. Well, we're all watching PPI to see what it means for PCE after CPI. and once we put all those acronyms aside, PPI for final demand up 0.2% comes in lower than anticipated and significantly lower than last month's 0.6%. The core also at 0.2. That's what was forecast. And the Supercore ex food, energy and trade at 0.2, also what was forecast. PPI on a year-over-year basis is up, though. Final demand 2.1%. It was 1.6%. There is some base effects coming into play there. The core 2.4%. That's up from 2%. The Supercore with trade included 2.8%. No change there. So on a month-over-month basis, good news basically from PPI. On a year-over-year basis, we see some increases. Jobless claims. After last week's jump up to a revised 222,000, we fall back to 211,000. So we are still in that range, and we are still seeing a relatively tight labor market. Continuing claims, 1,817,000. That is up from 1,791,000. But normally you'd say that might suggest people are having a harder time getting work, but this has been a very volatile number, goes up and down, so I don't think we can draw any conclusions from continuing claims.
Well, I can tell you, look at this recovery in the equity market. Let's start there. Equity futures, and start with the Russell if you want. Basically unchanged now on a session, on a small caps. We're positive on the Nasdaq by 0.1%, and erasing almost all the losses of the morning on the S&P 500. A rare piece of good news, and relative to yesterday, fantastic news. Jobless claims lower as well. Yields are lower by 2 basis points at the front end, 4.95. At the longer end on a 10-year, still higher by, let's call it 0.5 basis point. We were higher by 2. We're back to about 4.55. So, Lisa, not exactly undoing the moves of yesterday, but a rare piece of good news relative to the news 8:30 yesterday morning.
Again, the fact that the market moves at all on 0.1% one way or another, it just highlights how little people really understand this. The Russell 2000 is what I want to watch more closely, because if you get input prices to some of these smaller businesses that aren't rising quite as quickly as consumer prices, well, that speaks to the margin question, right? Can they pass along more of this than they're absorbing on the bottom line? But truly, what we're looking at right now is people toggling between, okay, is this it, sticky inflation long term? Or is this just basically a bump that's a little more problematic.
So, Mike, what is it? You can take CPI yesterday, a few elements from that, take PPI this morning, a few elements from that, push it through PCE. What do you get? Good news or bad?
Well, we're going to probably good news. Relative good news these days. PCE has always runs below CPI, and this is probably going to confirm that we will see a lower PCE number, which will factor into the Fed's thinking. I don't know that it changes it, but it doesn't factor in so much to the market's thinking, and it's your fault. According to the BLS, a major factor in the March increase in prices for final demand services, they were up 0.3. That was what really pushed things up, was securities brokerage, dealing, investment advice, and related services, which were up 3.1%. So cut prices over on Wall Street, and we have no problem anymore.
I'm sure this is going down really well right now on Wall Street. Is it? I don't think so.
Honestly, I think Wall Street's saying, cry us a river. Right now, we're looking at the idea of a little bit more of a rally into the front end. I do wonder how much the Fed's hands are really tied, though. The PPI doesn't matter as much as consumer prices, and the fact that the jobs market is just obviously robust, given the fact initial jobless claims confirm week after week after week. We do not have a layoff problem that's really evident in the numbers. How can they justify cutting rates in June? How could they justify cutting rates anytime soon with these kind of numbers, even if PPI came in a little bit light?
Well, as of today, which is April 11th, they can't justify it because the numbers don't show us, but we will get 2 more CPIs before the June meeting, and we will get another PCE before the June meeting, so we get 2 PCEs. So they will have some additional numbers to work with, and we'll see what happens with inflation in these various measures. But you go back to the old saying that 1 data point is a fluke, 2 is a coincidence, 3 is kind of a trend. And so we seem to have a trend in inflation here, and we'll have to see if that gets broken. We'll see what in final demand goods and PPI translates into CPI, which is not a direct translation for most things, but it sort of follows the same path.
Well, given PPI was better, potentially we'll get a little bit better PCE. But CPI is what everyday Americans think about when they think about inflation. How concerning is that inflation expectations for the future are going to be higher off of this now, not so much bumps, but as you say, trend?
Well, it would be something that you would be concerned about, and it's certainly possible that it can happen, but we have seen very high inflation over the past couple of years. That has now come down, but we didn't see consumer inflation expectations rise significantly, nor did we see business expectations for inflation rise significantly. So the Fed is relatively sanguine about that situation. Now, it'll be interesting to see, because this is political year, there'll be a lot of TV commercials talking about how inflation is terrible, and we'll see if that gets into people's heads.
I imagine very different TV commercials depending on the party. Mike McKee, thank you, sir. If you are just joining us, welcome. About 5 minutes ago, we got some economic data for you. PPI coming in at 0.2%. The estimate for final demand month over month was 0.3. So a little bit of a downside surprise there relative to the upside surprise of yesterday. Strip out food and energy, you get 0.2, bang in line with the estimate of 0.2. Lisa talking about jobless claims. We should talk about jobless claims. That came in at 211. The estimate was 215, so the right kind of downside surprise. Equities recover. The Russell was down hard this morning. Again, after big losses yesterday, it's positive by 0.25% on the Nasdaq, up 0.2%. On the S&P 500, just about unchanged. If you turn to the bond market, yields lower by 3 basis points now at the front end, back down to about 4.94 after getting closer and closer to 5% over the last 24 hours. On a 10-year yield, about 4.54 on a 10-year right now, 4.53.55. Joining us is Citi's Robert Sockin. Citi, I know you've got over at Citigroup, Robert, that call for June for a rate cut. And I just wonder, is it just about holding on by its fingernails after that PPI print?
Thanks so much for having me. Yeah, we're still holding on to that June call. I think it's a very close call at this point. As Michael McKee had said, once you have 3 months of data, you start to think that might be a trend. And we've seen fairly hot inflation data throughout the first quarter of this year. We do think we have to see how it shakes out with PPI. If core PCE is coming in around 0.3 is probably the limit, or maybe somewhere below that would be okay. If you're running that type of rate, we think Chair Powell would feel comfortable at least starting to ease in June. But again, if it comes in something like 0.3, that's probably the borderline where we'd feel comfortable. So I think the inflation numbers are going against the call, and certainly the probability of it have gone down. But that PPI, we'll see how it shakes out with the core PCE estimates. But overall, that's pretty good news. So we think, and also this is a Fed that seems to really want to get the easing cycle started at some point this year. So on balance, we're holding on to it. But again, it's going to depend on those next few inflation prints and how the labor market evolves.
Rob, for a while, you and the team at Citi have said this Federal Reserve has shifted emphasis. It's putting a greater emphasis on the potential for labour market weakness. And in line with that, I think the perceived reaction function from the market of the Federal Reserve has shifted as well. Maybe up until yesterday, there was this belief that the Federal Reserve could respond to adverse shocks, maybe weakness, pronounced weakness in the labour market because of these disinflationary trends. Rob, what I'm trying to understand is whether that story has been damaged by the print of yesterday or not. Do you think it has?
Yeah, this is the tough question, because that's certainly been part of the impetus for our call. Is we do think there is enough signs of softness in the labor market, not so much in the overall aggregate numbers. So hiring is still strong, jobless claims are still low, but you are seeing things like hiring intentions fall significantly from small businesses. You see things like the hiring rate drop notably in recent quarters. So we think there was enough softness that the Fed was getting worried that the labor market was weakening too much, and that you could be heading into a recession. I still think that's a big backbone of the call, but now that has to be weighed, as you said, against these stronger inflation prints. I do think if we do see more signs of weakening, the Fed would lean more on that element and still like to start this cutting cycle. But exactly as you said, it complicates the math, because before we were getting inflation that was good enough and some signs of softening, but the last few months have been much stronger inflation than we were expecting.
Rob, you kept saying that this is a Fed that wants to cut, and a lot of people have been asking why. And there are a lot of conspiracy theories, and then there are questions around just some of where the weakness is coming from. We heard from Jason Thomas of Carlyle earlier this morning that one of the reasons why is the deficit. And as it balloons, borrowing costs are getting more punitive for the United States. How much do you think that's factoring into the decision to try to cut rates at a time when a lot of that deficit's financed through T-bills?
Yeah, great. It's a great question. Certainly, on the one hand, those deficit numbers are looking very large, and interest costs have been growing significantly as a share of the overall deficit. I don't think, though, that that's the primary concern of the Fed. I think in the Fed's mind that they feel like they've done enough. They feel like they're restrictive, and they do feel like they're seeing enough progress on inflation and enough signs of loosening in the labor market and softening in the economy that they're willing to start easing, especially if they are starting to get concerned about those downside risk activity. So I don't think that concern is primary in their mind. But more broadly, I do think that is an issue, that deficits are getting big, and that's something policymakers have to pay attention to as interest costs are higher. But primarily, the Fed is focused on getting inflation back down to target and maintaining activity in the economy.
Rob, have you changed your long-term inflation forecast for the United States in the heels of some of these prints and your belief that the Fed will still cut?
We haven't changed the longer-term outlook in terms of inflation will gradually go back down to target over the next few years, have somewhat of a sticky path down because we think that services inflation is going to take longer than many people think to come back down to more stable levels. And as mentioned, still have the Fed cutting in June. But I think the risks around that forecast have changed. The risks are looking more tilted towards inflation stays even higher for longer than we've had. And the risks are looking that the Fed starts that easing cycle a bit later. So we're holding on to those similar views. But I think the risks have definitely tilted in a different direction.
Robert, this was great. It's fantastic to hear from you. Robert Stocking there of Citi, just about holding on to this June rate cut call. Question for us, I guess, this morning is how much the PPI printed this morning, downside surprise on a margin, offsets the damage of the upside surprise yesterday on CPI. I won't give you the answer. I'll allow the market to do that for you. Yesterday on the 2-year, we were higher by 23 basis points. This morning, we're down by about 5. So the answer, I guess, is a little bit. Let's give you an update on stories elsewhere. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The ECB has kept rates on hold for a 5th straight meeting. They signaled they're not far off from beginning to cut as well. Officials said that easing can start if their updated assessment of their inflation outlook increases confidence that prices are heading back to target in a sustained manner. Of course, they have the issue of widening rate differentials if the Fed cuts are pushed out. ECB President Christine Lagarde is set to hold a news conference in just a few minutes. That will be at 8:45 a.m. Eastern. The Justice Department has opened an extended antitrust investigation into Nippon Steel's takeover bid for U.S. Steel. The move likely delays the $14 billion deal. Both companies had hoped that it would be approved in the second or third quarter of this year. The potential takeover has become a hot-button issue for the presidential election. President Biden has said he wants U.S. Steel to remain domestically owned, but he stopped short of making an explicit push to kill the deal. Donald Trump has said he would try to block the takeover. A sweeping Russian missile attack on Ukraine has destroyed the largest power plant near the capital of Kyiv. Russian forces have ramped up strikes on energy infrastructure as Ukraine faces shortages of ammunition and manpower. Ukrainian President Volodymyr Zelensky called the air defense the biggest challenge today while making a visit to Lithuania. That's your Bloomberg Brief. John.
Danny, thank you. Up next on the programme, a news conference at the ECB with President Christine Lagarde. We'll do a couple of things over the next few minutes. In just a moment, we'll head over to Frankfurt, Germany, and we'll hear from President Christine Lagarde at the ECB following a rate call a little bit earlier, unchanged, but still expecting a June rate cut. And just crossing the Bloomberg, comments from the New York Fed President, John Williams. Bramo in focus after the big upside surprise yesterday on CPI.
This is the key. We're not there yet. We've made a lot of progress toward our goal of inflation, but we have not seen the total alignment of our dual mandate quite yet. He did anticipate bumps along the way, so here comes the bumps word again, which somehow has entered the transitory lexicon of some. But he is talking about how there is normalization in the labor market, expecting a peak unemployment rate of about 4% for the remainder of this year.
Aren't 3 bumps a bit of a trend? Shouldn't there be some pushback now to this conversation?
Well, the market's pushing back big time. And that's really going to be the key question. How does he respond to that? If he does indicate that the market is sniffing out what they also are, a pushback, it's going to be really curious to see. So far, it's non-committal from all of the Fed members who've been speaking. They aren't going to say this is going to change our view, but they're all raising caution, humility. We're not there yet. Waiting. Is that enough to have a couple of months' data that they're going to be convinced by June?
More Fed speak throughout today. Let's turn to the price action. Equity futures on the S&P 500 just about unchanged to negative by not even 0.1%, recovering after PPI comes in a little bit softer than expected. If we switch up the board and get to the bond market, the 2-year, 10-year, 30-year yields a bit lower now at the front end by 4 basis points at 493.55. And turn to foreign exchange, just getting introductory remarks in Frankfurt, Germany, before ECB press conference begins with President Christine Lagarde. The euro at 107.31. With the news conference in Frankfurt, Germany, here's the ECB President Christine Lagarde.